what and I welcome that was the recording came on, but I welcome everyone, and I second what Stephanie mentioned. Thank you all. This is a great group. We've been together for several sessions, and we hope to continue forward. Now, today's session is key ratio analysis. Tomorrow, we of course have our basic tax. So we'll do our basic tax 9 a.m. Eastern time till 3 p.m. roughly. And so we welcome you tomorrow as well. And you should have that link and the material coming out. If not, you may already have it. That's great. Now, to start off with today, I want to just talk just brief housekeeping items. We will take 2 5-minute breaks in the morning. We'll take 2 5-minute breaks in the afternoon, and then we'll take our half-hour lunch at roughly around 12 noon your time. And we may have a little discount because we have a smaller group today and kind of on the back end, but we will cover all the material. I do want to emphasize that today's session on the front end, we're actually going to be calculating the numbers. So if you have your cell phone handy, so you can grab your calculator on your cell phone, or like you see in the picture there on your screen, you can see if you've got a separate little calculator or even an Excel spreadsheet pulled up. Any of the three would work on your phone, separate calculator, or an Excel spreadsheet. So as we get started, emphasizing mainly calculating on the front end with interpreting as well. But on the back end, or the middle to the back end of today's presentation, almost exclusively interpreting the numbers, making sure we really understand where the numbers, what they really mean, and to interpret the numbers correctly. Now, we're going to go in depth on several different models and so forth. And I'll cover that in just a moment. Before we do so, I'd like to go ahead and do self-introductions. And I do want to emphasize, please, everyone, if at all possible, unmute yourself. Now, if you have background noise, of course, we would ask you to mute yourself, but as I call your name, unmute. But if possible, just keep yourself unmuted. And the reason why is when I call your name and like was mentioned, this is a live interactive. This is a live interactive session. So if you can please unmute yourselves, all of you, if you would do so, that would just be helpful, because we want the live interaction. Now, if you, for some reason, don't have access to the audio, mainly, a lot of times it's your computer, you don't have the speakers or whatever, no problem. We'll have you participate through the chat. But the preferred is not through the chat. The preferred is the live, if you will. Okay, so if you write this down, we need 4 items in our introduction. Number 1, your name. Number 2, the bank you're with. Number 3, where is, actually, we're gonna do 5 items. Whoa, 5 items. Your name, your bank. What town or city are you located in? And so your name, your bank, where you're located. Number 4, what is your main function in the bank? Not necessarily your title, but your function. And lastly, number 5, on a scale of 1 to 10. 10 is the highest, 1 is the lowest. 10 is the highest, 1 is the lowest. How would you rate your skill set with key ratio analysis? So number 1, your name. Number 2, your bank. Number 3, where are you located? in Michigan, but where? What town, city, what have you? Or if you're like in the Detroit market, what part? Number 4, what's your specialty or your main function in the bank? And then lastly, number 5, scale of 1 to 10. Are you a 5? Are you a 3? Are you a 7 or 8? 10 is the highest, 1's the lowest. Key ratio analysis. Go ahead, Jeremy, if you would, please. If you'd unmute yourself and give us your intro, please.
Sure. My name is Jeremy Smoot. I'm a financial analyst with Michigan Business Connection, and we work with banks and credit unions to provide commercial lending, origination, and servicing. I am currently living right in downtown Detroit, right on the river. I'm looking into Canada as we speak.
Wow, okay.
Yeah,
So,
yeah. In terms of ratio analysis, I'd probably rate myself maybe a 6 or a 7.
Okay, great. Right downtown. Interesting. Great.
A great location. Yeah.
Yeah, looking right over to Canada. Great. I know. I've been there, believe it or not. Yes. I mean, right in that area. Wow. Amy, how about you? Thank you, Jeremy. Amy, can you give us your intro, please?
Yeah, absolutely. So my name's Amy Leblanc. I work for Michigan Business Connection as well. We're located in Ann Arbor, and I live in Ann Arbor as well. I'm a portfolio manager here at MBC, and I would rate my skill set for ratios about a 4 or 5. We typically deal mostly with commercial real estate and don't typically use a lot of ratios in our analysis.
Okay. CRE real heavy. Good. All right. Well, thank you on that. Ben, how about you?
Good morning. My name is Ben Clement, also with MBC. Looking at your PowerPoint here.
Yeah.
I live in a smaller town, sort of just north of Ann Arbor, called Fenton, Michigan. And
Okay.
really new to the group. I started the end of the year, 2020. And my primary function, I'm a senior PM here on the team. My portfolio, like Amy's, is almost exclusively commercial real estate, held for investment, that sort of thing. Not a lot of operating companies. So I think that I'm sort of specializing in very few ratios right now. So I would rate myself probably around like a 5. And
Okay.
so yeah, we're
All
kind
right.
of focusing our underwrites on pretty specific things, and there's not a lot of deviation. So looking to learn some new stuff.
You bet. Excellent. Thank you. Michael, how about you?
My name is Michael Salsiccioli. I'm a financial analyst with New Underwriting. I live in Ann Arbor, Michigan, and then I would rate myself probably a 6 or 7. I think I hit all of
Okay.
your points.
You bet. Okay. And the name of your firm, so it's not a bank.
Oh, sorry, it's Michigan Business Connection.
Oh,
Along with
you're
everyone
also
else.
okay.
Yep.
You're also MBC. Okay. Mission Business Connection. Great. Ann Arbor. Okay. Great. Septarshi, how about you?
Yeah, hi, David. My name is Septarshi Chakraborty. Just like everyone else on this training session here, I'm also from Michigan Business Connection. I'm a financial analyst. I live in Ann Arbor. And when it comes to ratios, a lot of the deals that we work with are commercial real estate heavy. So we usually just deal with debt yield and loan to value. At least those are the 2 ratios I know. So I would say a 3 or a 4 when it comes to my intelligence on ratios. So
Okay. Great. Thank you, Septarshi. Aleem, how about you?
Hi everyone. I'm with Michigan Business Connection. I work as a financial analyst with the New Underwriting team, and I live in Tennessee. I work remotely, and I would rate
Wait.
myself,
I'm sorry, Aleem. Where do you live?
Tennessee, Mount Juliet, Tennessee. It's like 15 minutes away from Nashville.
Oh, okay. So you live in the Nashville market. Okay. But you're with the I know you're with the Michigan Business Connection, right?
Yes, that's right. That's right.
Okay, great.
And
So
I
Nashville
rate
area,
myself
okay,
around
great.
5
And
or 6.
about a 5 or a 6, great.
Yeah.
I didn't realize or remember that you lived in the Nashville. So how far from that you live to downtown Nashville?
15 minutes.
Oh, just 15, you're right there. You're in the Nashville
Yep.
market. I train there a couple times a year, and
Oh,
I was
okay.
just there. I was just there about 2 months ago at most.
Oh,
So ground based. It's unusual because of the COVID, but I am starting to get back out on the road. Kind of interesting. So, but and I was right there in Nashville. Not very close to Vanderbilt University. You know, of course, you know that area, I'm sure.
Yep. That's about 25 minutes away from me.
Yep. So right there. Well, it's good to be with each one of you. And my name is David Osborne. We've all been together, and I'm a business trainer, a contract CFO, and a college professor. Pardon me, and I'm a former banker, former commercial lender. Worked at B of A for Bank of America for about 9 years, but also worked at 2 community banks. And I know that, pardon me, the Michigan Business Connection, I know you work with banks, credit unions, you underwrite for them and service and so forth. And I need to ask Jeremy, help me remember this. You call it MBC, right? Is that right? Just for short?
That's correct, yes.
Okay, so MBC, like, help me remember, Jeremy, are you actually considered a CUSO, a credit union service organization, or are you different than a CUSO? Because when it's just the credit unions, usually it's called a CUSO.
Well, yeah, we're technically classified that way, but we work with both of them. So.
Okay, so you do actually both sides. Okay, got it. Good. Because the reason why I mention is, I don't know if I mentioned in a previous session, but I actually helped found a commercial lending CUSO, credit union service organization, where we would underwrite, we would service, pardon me, these mainly commercial real estate, but work with various institutions in multiple states and so forth. So that was years ago, but it was interesting. But welcome everyone to today's session. As I mentioned before, as I mentioned a moment ago, I'm back on the road a little bit. Last 3 weeks, I've been on the road every week, which is as the COVID numbers have come down, I've actually been back on the road, which is very unusual because for basically a year, not on the road at all, or maybe once or something, just very unusual. And but with the numbers decreasing in multiple states, once again back out on the road. Although now, looking at my calendar, I won't be back on the road till the end of June, so basically another month. But Zoom training, webinar training, essentially every day between now and then. Even before COVID, I did quite a bit of webinar, pardon me, based training for various groups, primarily the bankers, the CPAs, attorneys, credit managers. Credit managers are the credit professionals within a corporate or business setting. And so work with that group as well. These people primarily report to the CFO within the company, and their main function, the credit manager position, is to underwrite the larger receivables. And then when a certain amount of those receivables go bad, they collect. So they're kind of almost like an in-house commercial underwriter / collector. And this is a very well-established professional position, for lack of a better word. In fact, my title, MBA, CCRA, is Certified Credit and Risk Analyst through the National Association of Credit Management, which is a large nationwide trade association, and they have various credentialing and so forth. But that's my background. It's good to be with you, each of you. Now, today we're going to, as I mentioned, calculate more on the front end, some interpretation, back end, more the interpretation. But before we do so, I just need to ask, what software do you use to do the spreads? And Amy, what software do you use, and do you actually spread the numbers? Now, this is kind of a foreshadowing for later in the session. Kind of gives me a feel for the group.
Yep, we use SageWorks to
Okay.
spread our financials, and typically I will spread my own financials.
Okay, great. So SageWorks, good. And that's, you'll see this later in our session. That's one that we'll talk about. And it's a very standardized product in our industry, commercial lending. Now, for whatever it's worth, I use Moody's, but SageWorks is, from what I've seen, one of the most rapidly growing software within our industry, specifically amongst the bank, commercial lenders, credit analysts, and so forth. But SageWorks, in fact, I've looked at the product. It's a great product, in my opinion. And so it's, and it does the job. I mean, definitely does the job. So excellent to know that. Thank you so much, Amy. Moving right along, let's turn forward. Page number 2, you see my bio. As I mentioned, I'm a former banker, managed a commercial lending team at one point in time, worked at Bank of America, worked at 2 community banks, and so forth. So bottom left-hand side, as you well know, everyone in the group, I'm based in Las Vegas. Not originally, but lived here for over 33 years, full-time in Las Vegas. It's just amazing. Sometimes I'm thinking, no way. But by way of background, my father was career military. And so we lived everywhere. I mean, when I say everywhere, we lived, you all live in Michigan, upper Midwest. We lived right below you in Ohio twice, same Air Force Base, Wright-Patterson Air Force Base in Dayton, Ohio. We lived in Illinois, we lived in Florida, we lived in Utah, we lived in Germany, we lived in California, 3 places. I'm a native Californian. My father was stationed there. Went to high school in LA and so forth. In fact, my freshman year of high school in Dayton, Ohio area, half my freshman year, my first half, was in Dayton, Ohio area. And the other half was in Los Angeles, California. And people say, what? Well, that's what happens when your parent is career military. So, and as I mentioned, of course, go all over the country. The last 3 weeks, I've been in West Virginia, Oklahoma, and Montana, training, ground-based. But as you well know, I do provide ground-based training for the MBA, Michigan Bankers Association. The 2 major locations is Lansing, their main office, where Stephanie, our administrator's located in, and the other office is in, or the other location, pardon me, is up in Marquette, so in the UP. So I hope in the near future that we can get together. In fact, we do have some advanced classes coming up. And so if you'll see that on the calendar. But the advanced classes, if and I think this group would do very well, because we do have in the advanced classes, we have advanced financial statement analysis, we have advanced tax. Tomorrow we do the basic, and then we also have a full day, a half day is C&I lending, the other half is CRE lending, which is most of your world. But welcome you to attend those going forward, and I'm hoping that becomes ground-based in Lansing, so we can all see each other and so forth. Bottom left-hand side of the page, my email address, as I'm sure you already have, dlosborne@conx.net with the URN. Please, today, as we've seen in the past, this is going to be an open forum. I'll call in your name just like we've been doing. Number one. Number two, we will do class shout outs as we've done in the past, but please don't hesitate. Just interrupt me, say, hey, David, I've got a question on this, that, whatever. And then also, don't hesitate. When you've got a question, 2 weeks from now or a month from now, don't hesitate. Reach out to me and just say, I've got a question, and I'd be glad to, I'll respond if I can do it quickly through email. If I determine it to be more complicated, I will, I'll actually call you. And I do this all the time. I call credit analysts, loan officers, you name it. If I determine, boy, it's going to be more efficient just to walk through the numbers or the concept, especially tomorrow's theme, tax. Let's do a class shout out. How many of us will be together tomorrow for our basic tax? Just yes or no. Everybody, if you'd unmute your lines and just shout out yes or no.
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 Oh, well, do we have, because I know we have a class tomorrow. Is anyone going to be with us tomorrow for the basic tax?
No, David, like we originally, there was a bit of a miscommunication where we got signed up for that, but a lot of us already took the basic tasks one with you. So we're
Okay.
not gonna be taking the one tomorrow though.
Okay, so you won't be with us tomorrow. Okay, and I can't remember which group, but thank you for that update. So then, like I said, now in September, we've got, it's like the middle of September, we've got the 3 days of advanced, which in my opinion would be very effective for each one of you. So including the advanced tax, because since we were together even, and help me remember, when were we together for the basic tax? Roughly, it was a couple months ago, or
A couple months ago, I think. I
Okay.
just started in December, so I did that and financial
okay.
analysis with you. So
Okay,
we had a couple
the
of-
reason why I say that is that for whatever it's worth, we do go through some of the same PowerPoints as far, the material, but the whole theme of the class is more from a tax strategy, understanding the tax strategy of your small to medium-sized business borrower, including from a commercial real estate perspective. Legitimate, these are not these are tax avoidance, not tax evasion. These are not, some obscure, tax evasion ploy or whatever. The main theme of the advanced tax class is understanding legitimate strategies to help your borrowers, not giving them tax advice, but understanding legitimate strategies. And of course, we also do the tax updates. And since our class, some of these things have happened with the Biden administration that it's even more updated for whatever it's worth in our tax updates. So that's on the advanced. But once again, it's a 3-day series in September. First day, advanced financial statement analysis, cash flow. Second day, advanced tax. Third day, C&I lending in the morning, commercial industrial lending, CRE lending in the afternoon. Now, with that, let's just jump forward. And I thought everybody was going to be with us tomorrow, so we do no introductions tomorrow, but that's fine. But please consider September. Now, page number 3. Before we jump into this, that we're going to cover 4 areas today. Intro, which we're doing right now. Then we're going to go into the LALOC model. LALOC, it's an acronym, which we'll cover in a moment. The LALOC model is the heart of today's session. It covers the key ratio analysis. Then section number 3, we're going to look at the spreadsheet. We're going to look at the spreadsheet. It happens to be a Moody's spreadsheet versus Sage work, but very similar. We're going to look in detail. Now, within the LALOC model, section 2, I'm going to have you crunch the numbers and interpret the numbers. On the spreadsheet, the numbers are already spread in section 3. So that's mainly interpreting the numbers. And then section number 4, we're going to cover 2 advanced key ratios. The Altman Z-score, bankruptcy predictor, and the sustainable growth model. So 2 advanced key ratios. Oftentimes you don't see, even in a typical key ratio analysis class like today. So once again, introduction, Leblanc, the spreads, and then the 2 advanced models. Okay, to really move forward through to conclude this intro section, look here on page number 3. We've got creditor, investor, manager, and guarantor. Who really uses the key ratios? Well, you can see creditor. I take your highlighter, I grab a highlighter, pen as well, and highlight bank loan officer and bond rating analyst. You're the bank loan officer, essentially. You look at the numbers. From what perspective? Main perspective, as you can see on the second line down, can the company repay its debts? Can they cash flow? Heavy on the cash flow. But a bond rating analyst will do similar. They hang out on Wall Street, typically, and other areas of the country. But Wall Street's heavy. They analyze the corporation or the school district or the city and the municipality's ability. City of Detroit, City of Ann Arbor's ability to service that bond, that long-term debt instrument. Number 2, I'd circle or highlight stock analyst. They look at the numbers a little differently, more efficiency, risk, growth, so forth. I'll say it straight up front. A stock analyst, and if you'd add this to your notes next to or underneath that second area, stock analyst from a large publicly traded corporation perspective typically does not look at the numbers, the key ratios, as much as we will from a cash flow perspective. But what they do look at, pardon me, besides the PE ratio, price earnings ratio, and all these others that they kind of really fixate on, they'll look at from the perspective of if it's a large publicly traded company from other areas than cash flow. Like I said, PE ratio and a few other areas. Some of the ones we're going to look at today from a creditor perspective. But if they're analyzing, not a stock analyst, but like a business valuation analyst, or and it's the actual title is CVA, sort of like Certified Valuation Analyst, CVA. So the CPA, it's CVA. A lot of CPAs are also CVAs. If it's a privately held firm, believe it or not, the big emphasis from an investment, ownership, sale, buy, sell perspective is a multiple. It is a multiple of EBITDA, of the cash flow that we're going to cover. So if you have a client that's going to sell their operating business, and I know most of you work heavy on the CRE side, but a lot of today's info is more from the operating, which is good for you to know, especially if the MBC starts to expand into more of the operating businesses. Ben, just confidentially, for my benefit, is the MBC is the goal, because you're heavy on the CRE, is the goal to expand into more C&I credits, commercial, industrial, more lines of credit, equipment financing, non-commercial real estate?
I don't think that is part of the future vision. It's just, like I said, I'm fairly new, but I don't think that is the case. I think it's more so the case that investment real estate is kind of the sweet spot. particularly because it's not our funds. We're administering this on behalf of someone else, and the appetite that they have out there for debt is, pretty risk averse.
Yes.
And they like these investment properties that cash flow, but that are really well locked down with collateral values. So I don't really see C&I being kind of a growth area for us.
Okay. But you are analyzing if it's an income producing property, you, correct me if I'm wrong, Ben, you are analyzing you're starting to analyze the underlying business. Is that correct?
Certainly, yeah. And there's a lot of these that are not just held in a portfolio of investment, but rather they're a single tenant, they're owner occupied. So our primary source of repayment on those a lot of times will be the operating results
Oh,
from an
excellent.
outflow.
Thank you.
Yeah,
Excellent.
but I wouldn't say that's the majority, and I wouldn't say it's a preference, but it's certainly something we want to be well versed in, and we underwrite
Yes.
opcos all the time.
Good. Excellent. Which is really the theme today, is more the operating business. Excellent. And in September, the CNI have the morning session CNI, the afternoon CRE. That CNI piece is the operating business. Excellent. Good. Now, once again, back to investor. If a small to medium sized privately held business is bought and sold, believe it or not, it's a multiple. 1 times or 2 times EBITDA on the actual cash flow of the operating business. Now that's for the small business. Large business with the stock analyst, when they're bought and sold, it's usually a multiple of book value. Their book value, their equity. It's a whole different arena. Number 3, I would circle or highlight business owners and managers. And right above business owner, I'd put the letter P. Right above manager, I'd put the letter A. What's the business owner? The principal or owner of the business. What's the letter A? Agent, such as the CFO or the COO. So the business owner, principal, or P. The manager, such as a CFO as an example, the letter A, agent. These 2 parties may agree on the key ratios. They may not agree on the key ratios. They may not agree completely. They may be in sync completely, and they may be totally. In fact, if you deal with them, this is a challenge under manager with the key ratios. A lot of times we get comfortable working with the manager, the CFO, because she speaks our language, the language of credit oftentimes, or at least they may have some background in credit, at least some. Now, professionally, they may be credentialed as a CPA or some other credential. But oftentimes we get real comfortable with the CFO, the manager. But then all of a sudden we realize that sometimes the business owner of the operating business, once again, the business owner, like for example, we've used the example Bob and Sue. We've used the example as the business owners in the past. Jane is the CFO or whatever. Well, all of a sudden we have a discussion with Bob and Sue, and sometimes we realize, wait a minute, Bob and Sue really know the key ratios better because they've been in the industry, their specific industry for their company longer or more in depth than even Jane, the CFO. Nothing wrong with Jane. But please, one thought on this 3rd section. When you discuss or negotiate the numbers with the Janes of the world, I'm not saying don't do it, but what I am saying is don't lose track of the business owners, the principals or owners of the business. Bob and Sue are imaginary couple that we've used in the past in our sessions. Let's don't lose track of them. Please, plus, this is another thought. Kind of bottom line in the end, who is the guarantor or guarantors? It's Bob and Sue. It's not Jane. Nothing wrong with Jane. Jane's valuable. But when I was on your side of the table as a commercial lender for many years, I fell into this trap a couple of times, distinctly a couple of times, where I got so comfortable working with the manager, with the CFO, the agent, that I have to admit, I lost track of my relationship with the business owners, pardon me, / guarantors of the credit. And the positive is that Jane and I had this great relationship, and the numbers would be there and timely, and I always had access to her. Whereas the business owners, boy, a couple of times the business was just flying high most often. So the business owners were just very busy. But then I realized, wait a minute. Sometimes when I meet with Bob and Sue, the business owners, I realized Jane wasn't telling me the whole story. Now, in most situations, the Janes of the world, oh, no, what she told me was exactly what Bob and Sue later told me. I mean, I could tell they were in sync, but a couple of times they weren't. And it was like, oh, wait a minute. This business owner and the business manager, they are not in sync. And when I say in sync, even on the numbers, the key ratios, and their interpretation of their own company's numbers. Go to number 4, if you would. If I'd highlight business owners, guarantor, and on the second line down, if you'd circle related ratio analysis. Okay. Related ratio analysis. We're going to look at not on all the models, but on several of the key ratios for the business. We're going to tie it to the business owner. And this is because of this relates, I should say, to a legal phrase, if you put at the bottom of this page, right below guarantor, please. It's called the alter ego theory. Alter ego theory. It's a legal phrase. Now, what is alter ego theory? In a small business, small to medium sized, privately held business, the business and the business owners are essentially one and the same, or they're the alter ego of each other. They can be exchanged for each other. They're basically one and the same. Alter ego theory is the legal phrase. In a small to medium sized operating business versus an income producing building, loan, CRE loan on a building that you may not even have the underlying financial statements. Well, in an owner-occupied deal, you would, and we want that and we want the personal financial statement and personal tax returns of the business owner or owners, because we've got to tie the two together. If we don't, in most small to medium-sized business situations, you miss half the story. Okay, Mike, I need to ask you, in your underwriting for MBC, do you, if it's an income producing building, you may not even have underlying financials. Is that correct, Mike?
Yeah, if it's an income producing building, we might not have a balance sheet.
Yeah, no financials on the operator and the business owners. Bob and Sue say, well, here's the rent roll. Here are our numbers on the rents, but there's 5 or 10 tenants in the building. And you may have a situation where you don't have the numbers, so you can't even do the key ratios on those tenants. And when you ask Bob and Sue or Jane, their CFO, they laugh. Oh, Jane says, we can't even get them. But Mike, when you have a owner occupied building, 51% or more of the buildings occupied by a related entity. Bob and Sue have ABC LLC, a manufacturing firm. They have XYZ LLC. They own the building they lease to themselves. In that situation, Mike, do you have financials and tax returns on the operating business?
Yes, because in that case, if it's 51% owner occupied, we normally require the operating entity
Got
to
it.
go borrow the loan.
Got it. Oh, you actually do co-borrower. You don't have Bob and Sue as guarantor?
We usually take Bob and Sue as the guarantor and the operating company as a co-borrower.
Really? Interesting structure. I'm glad we went here. This is good. So the borrowing entity is the building, commercial real estate deal. The operating, which is XYZ LLC, Mike, and then the operating business is ABC LLC, the manufacturing firm. You actually have those two as co-borrower with Bob and Sue, who own both businesses 100%, as guarantors, correct?
Correct. That's what we would usually do.
Interesting. In some markets, for whatever it's worth, and in the banking industry, over many decades, the banking industry in America will go in waves. The bank attorneys, and I've seen this, I've seen it a couple of times in my career, both as a former banker, lender, and as a CFO, because I'm just on the opposite side of the desk from you as a lender. Well, I've seen this where the bank attorneys say, we think that we want, not necessarily if we have the two businesses where you have the building and the operating business as co-borrowers, but I've seen this in waves where the attorneys say, like if we give a loan, like an equipment loan or a line of credit to the operating business, to ABC LLC, the manufacturer, we want Bob and Sue to be the co-borrowers. Does that make sense, Mike?
Yeah, it makes sense.
So in other words, it's not the two businesses as co-borrowers, but it's where there's a real estate. No, this is on the CNI side, line of credit, equipment loan, for example. But the bank's attorneys say, well, we want ABC LLC, pardon me, the manufacturer, and Bob and Sue, the principals, to be co-borrowers. So, but the last one I saw, it was only about 18 months long, meaning it's like a fad almost. And then all of a sudden the attorneys start saying, nah, we don't like that. We want them to be more traditional borrower, which is the manufacturing firm, ABC LLC, Bob and Sue as guarantors, not as co. Interesting though, the way they would structure. Mike, I don't mean to go too deep on this, but do you know, is that per NBC's legal counsel, or is that driven by your clients, certain banks, certain credit unions? I'm just curious.
I believe that's our policy. I think that's driven by NBC, but I'm not 100%.
I think you're right about that, Michael. That's my understanding as well.
Okay. And Mike, you go by Mike or Michael?
Either one's fine.
Okay, good. Okay, because I put you down as Mike. Okay, no
David,
problem.
just to add one quick thing to that, I think that it's worked well for NBC and for the organizations we support, because if you need to take a credit action midstream in a loan, if it's a guarantor, you have to default them first. And so we found with, whereas if it's a co-borrower, you do not.
Interesting. You're talking about between the two businesses, the operating business and the real estate. And I agree with you. When it's a co-situation, you don't have to have the default. Whereas traditionally, there has to be the default on the lead, if you will, and then go after the guarantors. Interesting.
Exactly. Yeah.
Very interesting. I have to admit, I have never, in all my career, both sides of the, as a lender, as a CFO, I've never seen where legal had the co-borrower between the two entities that Bob and Sue own. Interesting. Very interesting. And then their guarantee. Excellent. What we will see as we go into the key ratios, to summarize this little section, the related analysis for them, meaning the borrowers themselves, the business owners themselves, the guarantors. Moving right along. Now we're going to go into section number 2. We've done our intro. Laylock. Now, this is the heart of today's session. If you would please add this to your notes off to the right of each one of these, the little definition, just a brief definition. Liquidity. The company is defined as follows. The company's ability to service its short-term obligations, less than 12 months. The company's ability or the borrower's ability to service its short-term obligations. Another way to define liquidity, the nearest to cash, the nearest to cash. Activity. Model number 2 activity, defined as the turn factors or swing factors. Turn factors or swing factors. Now, we're going to be talking in this section, ARAP and inventory turnover. ARAP and inventory turnover. Model number 3 of the 5-step laylock model. And by the way, the acronym, before we forget, if you just circle or highlight the first letter of each of these, LALOC, just to highlight, laylock. Leverage. Now, the definition of leverage, the company's ability to service its long-term obligations, more than 12 months. But in this third category, I like to think in terms of 3, 4, 5 years out, even at least 2 years, but even 3, 4, and 5 years out. Long-term. Number 4, the O of the laylock model, operating performance, defined as the profitability of the business. The profitability of the business. Now that could be a loss as well. But is it profitable? When you say profitability, well, you say net profit, but if there's bracketed, of course, that's a loss. So profitability of the business or lack thereof. And then number 5, the brief definition, cash in versus cash out. Cash in versus cash out. Otherwise known as lifeblood. Now, from a financial perspective, the lifeblood of the business is this cash flow. From a financial perspective, the lifeblood of a household is cash flow. Septarshi, would you agree with me? From a financial perspective, the lifeblood of a household even is this cash flow, cash in versus cash out.
Oh, absolutely. Yep.
Oh, yeah. I mean, and that's what happened with the pandemic is, depending on the industry that the individual or the couple were in, they may have lost their jobs, or if they owned a business and tied into, the restaurant or entertainment, boy, they suffered. Although some businesses actually have excelled. We're going to see this in our first of our 2 major case studies today in just a moment, where the pandemic, they've actually accelerated during 2020, the numbers. I mean, it's like, what? We'll come back to that. Okay, now we're going to do a quick activity. The laylock model is the theme of today's session, the heart of it. Off to the left of liquidity, you see that bullet point. And just up one line, if you kind of squeeze in, you should have enough space side of your page, squeeze in the word short term. So just to the left of liquidity and one line up, short term. Okay. Then over to the far right, past the definitions, to the right of liquidity, way over to the right, and one line up, if you put long term. Okay, I'm going to have you do the one side, we'll talk about it, and then we'll do the other side, talk about it. From a short term, when we say short term, borrowing from the discipline of accounting, less than 12 months, how would you prioritize these 5 categories. And we're going to see key ratios in each one of these, of course, each of them, and some multiple key ratios. So let me give you a hint, short term. The bottom of that column, right next to the left of cash flow, if you'd please put a number 1. Cash flow is number 1 in the Leblanc model. In other words, you may say, well, why do we have it in this order? This is the traditional order that most banks will address the key ratios in their loan write-ups. Aline, what do you call your loan write-ups at MBC? What do you call it? Is just a loan write-up? Is it a credit memorandum? What do you call it?
Normally we do the, like, if we're doing analysis, then we just do conditional loan analysis or loan analysis, or if we're just doing a pre-qualification, then that would be a pre-qualification.
Okay, so you don't actually do the full loan presentation or write-up for the client, for the bank or credit union?
That is for the whole loan analysis or the conditional loan analysis. That is all for the credit union or the bank that we.
Okay. Oh, so Aline, they do that. They do it. You're just inputting the analysis. Is that correct?
I don't get your question. What do you mean they do it?
Okay. In other words, who does the actual loan write-up? It's usually in a bank, it's called a loan write-up or a credit memorandum. Do you do that? Does MBC do that? Or do you just input?
Yeah, MBC does that.
Okay, so you do the full, you do the full write-up, correct? Or
yes,
loan,
exactly.
It's usually called a loan write-up, loan presentation, or a lot of banks call it officially, even though they may say loan write-up, they call it officially a credit memorandum. So you do that. How many pages besides the spreadsheet, besides the SageWorks spreadsheet, how many pages, Aline, is usually your write-up? Just curious. 3 pages, 5 pages?
It depends on the deal, basically.
But I mean, typically 10 pages?
On average, yeah, you can say that.
Okay, so 10 pages. Jeremy, how about
8 to 10. Yeah, 8 to 10.
10, 8 to 10. Jeremy, the same with you? Is it about 8 to 10?
Well, what I would say with that is that Aline works on the underwriting side, so theirs is probably a little more in detail when they're doing the conditional loan analysis he talked about. That's going to be like the full underwriting.
Okay.
For us, we're looking, we're on the portfolio management side, so we're more looking at ongoing risk monitoring.
Gotcha.
So it kind of depends. There's things we'll do, like a quarterly review is usually just a couple pages, and annual reviews maybe 4 or 5. And
Okay.
Then we have,
Yours is more portfolio. His is more front end.
Right.
Okay.
The closest thing we do is a renewal analysis when they're looking to refinance an existing loan. So that'll be similar, but a little less in depth than what they do there.
Okay.
So that's probably looking around 7 or 8
Okay.
pages. It's similar length.
Okay. This is good. This is what's really nice is that you're all from the same organization, so we can talk detailed. Okay. Amy, how about in your part of MBC? Are you more with Jeremy on the portfolio? Or are you more with the Aline?
I'm with Jeremy on the PM side of things.
Gotcha. Ben, how about you? Are you more with Jeremy? Or you more with Aline? Aline full scale, Jeremy more portfolio management.
Portfolio management.
Portfolio. Mike, how about you? Portfolio management or more Aline?
I'm new underwriting with Aline.
Okay, with Aline. And Septarshi, what about you? You more with Aline or more with Jeremy?
More with Jeremy because I'm a financial analyst on the PM side.
Okay, gotcha. Okay, got it. Okay, excellent. Now, most banks, for whatever it's worth, in their loan write-ups, their credit memorandums, in the financial analysis section, which is usually section 3 of the write-up, they will cover the key ratios in this order. Okay, liquidity all the way down to cash flow. Even though short-term, less than 12 months, I had you put a number 1 on the left. And you may say, well, why? Well, we're going to reorder this because it's tradition. It's for whatever it's worth. The bank loan officers the kind of the mentality is we save cash flow, which is number one, for the crescendo or the end of the financial analysis section of the write-up. So even though it's number one, we leave it for kind of like the crescendo or kind of, the ending of the analysis, financial analysis. What I'd like everyone to do is spend just a couple minutes on this. Put a number next to the other four. Number one, this is short term, short term, less than 12 months. We know cash flow is number one. Think in terms of more the operating business, not the real estate, operating the tenant, the operating tenant. What would be number two, number three, number four, and number five? So take just a moment on the left side, and I've given you the hint. Number one is cash flow. And remember, we're talking short term, not long term. Short term. So what would be number two? Like what would be the closest to cash flow? And then, further out, longer term type concept. Short term to longer. That's the hint. Take just a moment more on this and just number these. I'm going to ask a few of you. Okay, take just a moment more. If you just put a number, just put, 1 to 5, but starting with number one is cash flow. Okay, here we go. Aleem, number one's cash flow. What would you say is number two?
I had liquidity and operating performance.
Okay, liquidity. Number two, liquidity. Jeremy, what did you put for number two? Thank you, Aleem. Jeremy, what'd you put for number two?
I also put liquidity for number two.
Liquidity, excellent. Number two is liquidity, absolutely. Okay, Amy, what'd you put for number three?
Leverage.
Leverage, okay. Ben, what'd you put for number three?
Operating performance.
Operating performance. Mike, what'd you put for number three?
I put leverage.
Leverage. Septarshi, what'd you put for number three?
I said operating performance as well.
Okay. Number one's cash flow. Remember, short term. Number two, liquidity. Number three, activity. Number four, operating performance. And number five is leverage. Okay, remember, this is an operating business, short term, cash flow, liquidity, activity, operating performance, and the last would be leverage.
I
Okay.
don't remember what you called operating performance. How did you describe that?
Remember operating performance, profitability,
Oh.
profit or loss of the business. Yeah, the profitability or profit or loss of the business. Number four in the list. And it'd be number four also in our pecking order, and then leverage number five. Okay. Okay, now let's go to the far right, past the definitions. You already put long term. Now think in terms of not technically per accounting concepts or GAAP, generally accepted accounting principles. We would usually think of just more than 12 months. Well, think in terms of even 2, 3, 5 years out from the operating performance perspective, the operating business. And operating performance is profitability. Okay, same model, same definitions. Okay, let me give you the hint. Number one is still cash flow. When we're looking at 2, 3, 5 years out from the operating business, Cash flow is number one. Number one is cash flow. So on your list over to the far right, put number one straight across from cash flow. What would be number 2, 3, 4, and 5? And the hint is it's a complete shift in mindset from the list on the far left. Cash flow is number one, but big picture, long term, what's the number 2, 3, 4, and 5? Somewhat reversed order, somewhat. That's the hint. Take just a moment and complete this if you would. What would you say is number 2, 3, 4, and 5? Take just another moment or so. Think about this. Okay, here we go. Here we go. Aline, number one is cash flow. What's number 2? What would you say number 2? Big picture, long term.
Leverage.
Okay, thank you. Jeremy, what'd you put for number 2?
I put operating performance.
You were right on. You're right on. Number 1 is cash flow. Number 2 is operating performance. Long term, the business, if it never reaches operating performance, traditionally it will die. During 1999, 2000, 2001, 2002, we had what was called the dot-com implosion. Thousands of companies sprang up overnight in the late 90s. And they were considered dot-com online. This was novel at the time. I mean, today it's just standard. And all these tech companies, all this, and billions of dollars were being thrown at these businesses. So their cash flow was positive. But it wasn't because of their performance. It was because of investor dollars. Well, many of these never reached operating performance. And they died on the vine, so to speak. Okay. There's one major exception. Amazon, believe it or not. In that era, Amazon was in that era, and it was losing money, and people couldn't scratch their heads like, how does this company stay in business? Da, 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 da. Well, the rest is history, so to speak. Number 1, cash flow, big picture, long term, 2, 3, 4, 5 years out. Number 2, operating performance. Amy, what'd you get for number 3?
I put leverage.
You were right on. You were right on. Leverage, number 3. What is number 4? Ben, what's number 4?
Activity.
Yes, correct. And lastly, of course, liquidity. So it's somewhat of a reverse mentality. Still cash flow, number 1. But operating performance, the big one, number 2. They've got to reach that. Even a small business, especially in a small business that doesn't have, all these thousands of investors throwing millions or even billions of dollars at them. Absolutely. Now, once again, the order that we're going to take to do the key ratios is in this order: lay lock. Just the traditional, although I saw a bank, it had a same models or same exact categories, but for whatever reason, activity and leverage were switched in the order. It's kind of interesting. But they're still the same. Most banks will cover these 5. Some banks will miss a few, or maybe alter, as I mentioned, alter the order. but almost all banks that I work with in their loan write-ups or loan presentations, credit memorandums, they save cash flow for the crescendo of the analysis. Let's turn to page number 5. Now, we're going to take a detour for just a moment, and then we're going to jump back into Leblanc extensively, crunch the numbers and so forth. We're going to spend just a quick review of the financial statements. Why? This is a reminder that if the financial statements are garbage or inaccurate, there's no way your key ratios can be accurate. Here, of course, are the 4 basic financial statements. Of the 4 basic financial statements, which are the 2 that we use most readily within key ratio analysis? Income statement, otherwise known as the P&L, profit loss, and the balance sheet. Okay, I'd highlight those 2. But the key here is accuracy. Let me illustrate. As a team leader, as I mentioned, of a commercial lending team, I had quite a few administrative duties I was working on, because I was the manager of the commercial lending team, but we were housed in a branch. So our offices were sort of, they were kind of to the side and wrapped around the back of the building from the branch. So we were kind of separated from the branch, but I was also sort of for lack of a better word, the branch manager. Or I wasn't titled the branch manager, I was like the office manager. The operational side of the office had an operations supervisor, and then they had an actual branch manager. She didn't really report to me, she reported to another chain in the bank, but senior management downtown's idea was, if you were the commercial lending center manager, by default, you really sort of manage the whole building. Any major issues from operation came to you. Luckily, I had a very strong ops manager, or a branch manager, and she managed it all, and I had not that many issues, but still had some administrative. I have 10 new loan requests on my credenza, just out of nowhere, and they just stacked up because I got a little busy on the other end. And I sat down and I told my administrative assistant, I said, closing my door unless there's an emergency, don't interrupt me. I got to get through these deals. I started looking through the first deal from an accounting perspective, and these were all small to medium-sized local businesses, all legitimate, all real businesses. But I said to myself, I got to get through this stack of 10 and kind of whittle through them and say, which of these can I know we can't decline them, and which could, hey, no, I can work on this. Well, first deal I look at, the balance sheets don't balance. I'm going like, oh, great. So I put it off to the side. Now, from an accounting perspective, because of my accounting background, I'm like, oh, I put that to the side. Then I get to the second deal, and the underlying numbers are not the swiftest. And I'm thinking, oh, great. Put that to the side. I get to the third one. Same scenario, which I'm sure many of you see. Mike, do you see this with your borrowers, the operating companies, that sometimes the financials are, you shake your head like, the accounting, who's doing the accounting? Mike, have you ever had that experience?
Yes.
Septarshi, thank you, Mike. How about you, Septarshi? You ever had that experience where you look at the numbers like, what? Meaning the underlying numbers.
Oh, absolutely. Yep.
Oh, yeah. Okay, now, what did I do? I'm in a hurry. I got 10 of these. And the people are starting to call, because I had some of these other duties with the branch, not so much with the branch, but even our lending center and all these management meetings I'm in downtown, and all the other managers of the lending centers. And I'm like, and I'm back, because I have even though I'm the manager, I have an active loan portfolio. See, some team leaders in a bank do not have active loan portfolios. So they are literally just managing the team, going out on calls with their loan officers and so forth interacting with if they're in a behind, the building, but there's a branch attached to them, interacting with senior management downtown or whatever. Okay. So I said to myself after the third one in a row, well, I'm not responsible for the underlying financial statements. That's the James of the world, the CFO / controller in the business, or that's the independent CPA George that's preparing these. Usually these were company prepared. Make a long story short, I just said, I'm gonna weed through them, which I did. Okay, I'm gonna work on these, these 4 decline right out of the chute. We can't touch them. These 6 I'm gonna actually work on. So that's what I did. I declined the 4, which I knew I could do a quick no. And the 6 I started working on. Well, I start working on the 6. And the first one out of the chute, I'm working on it about halfway through. I'm thinking, and of course I'm getting it ready to send to the credit analyst, even though I'd been the credit analyst, years before, send it to the team, send all 6 of them down to get spread, And then I caught myself and I said, what a joke. I'm going to send these 6 down to the credit analyst and have them spread these numbers knowing that the underlying financial statements are just garbage. I just say it straight out. And not to be mean, but these are nice small businesses, legitimate people, legitimate businesses, but knowing that these numbers will come back and the underlying numbers are garbage. Well, how can the analysis be anything but garbage or inaccurate, to be polite? Aline, you actually spread the numbers, is that correct?
Yes.
Okay, you do. Jeremy, do you spread the numbers or not so much because you're more on the portfolio management?
Yes, I do too. I think.
Oh, you do too. You all do. Okay. Amy, you spread the numbers as well?
Yep.
Okay, everybody does. Excellent. Thank you. Well, what do you do? Ben, what would you do if you were me? And I stopped myself and I said, this is a joke. Why am I doing this? Man, I have to admit, I turned right around, shipped him right downtown to the centralized credit analyst team, and they spread them, and literally a day later I had them all back, and now I'm going through and I'm actually doing my loan write-ups and proceeding funded those deals, knowing that the underlying financials were garbage. Ben, what are your thoughts on that? Is that illogical?
I would probably send them to be spread,
Okay.
just to take a closer look. I think that if someone applies and goes through that process, I sort of owe that to them, an actual decision. And
Okay.
but then the next step that you took, which was approving and funding those loans, I probably would pump the brakes on that.
Okay.
At least until I could have, when I did SBA lending, it was a lot more startups and younger sort of entrepreneurs, and sometimes maybe like a coaching session about financial statements or the importance of them and that kind of thing, and trying to help them to level up their skills in that area. But I certainly wouldn't be sending our clients funds chasing after that little education that those folks might need.
Excellent comment. Seriously. Oh, yeah, educate them. Yeah, very good point. Okay, now before we go back to the Leblanc model, those were excellent comments. That was excellent. Bottom left-hand side of the page, let's just do a quick review of the quality of financial reporting. At the bottom left, you can see that blank spot, the very, very bottom. If you would please put in your notes, company prepared. And then put right next to that, QuickBooks. I put a little note even further. Some commercial lenders, loan officers, credit analysts, you name it. Some of them make the mistake of bashing QuickBooks because the QuickBooks, the balance sheets don't balance. It's not the software, it's the individual that's managing the software. So I would add this to your notes on the bottom left-hand side. QuickBooks is state-of-the-art software, accounting software. It's not the software that's the culprit. It's who in the company. It's not Jane. It's no, she's sophisticated. She's the CFO. No, in a small business, no, it's a lower level bookkeeper. Oftentimes, it's not even a bookkeeper. It's just someone, an administrative assistant, which is nothing wrong with being an administrative assistant, but has no accounting background. And they're just saying, hey, get on that program. Oh, you can do it and just crank these numbers out. Okay. Wow. Company prepared, we're suspect. Let's go higher levels. So we're at the bottom. Now go one notch higher, if you would. CPA compiled. Using George, the independent CPA as our example, George will take the QuickBooks from the company and put them into his format and put a big disclaimer. These are the numbers of management, but most CPAs behind closed doors, they will adjust some of those numbers. Now, do they go out to the company? No. Do they review the books to the company? No. Is it anywhere close to an audit? No way. But at least on a CPA compiled, it's a little higher level. Now let's go higher. Go to the third level higher, CPA reviewed. Here, our imaginary CPA, that's for Bob and Sue's company, ABC LLC, and the real estate side, because they own their building, XYZ LLC. George will go out and camp out for a week or 3 days or whatever at ABC LLC in the conference room, work with Jane, the CFO controller, dig through the books and review the books per GAAP, generally accepted accounting principles, GAAP for short. And it's a much higher level. Now let's go to the very top. Pardon me, right above CPA reviewed, if you put CPA audited, okay, top level. Now what's a CPA audit? George will go out, camp out for a week in the conference room or more. But in addition to reviewing the books per GAAP, he will also send confirmation letters out. And this is huge part of an audit. Confirmation letters to your bank to confirm all deposit and loan or credit balances. They've got a line of credit to the company. Well, what's the outstanding balance? Mike, by the way, do you do any lines of credit through MBC at all or no lines?
Yeah, we'll do line of credits.
Okay, so you do lines. Mike, do you do any equipment financing?
Yes, we do some equipment financing.
Okay, so you got some, good. And of course, CRE, your mainstay. Whatever the loan is, whatever the deposit relationship with your bank, the CPA George will send that confirmation letter out to the bank, to your bank. Here's another confirmation letter on all of the company's receivables and payables as of 12/31 of 20, whatever the year of the audit, the year end, like 12/31 of 20 as an example. If there are too many receivables, too many payables on the list, they'll do a sample. Believe it or not, they'll just do a random sample, confirming those balances, to ABC LLC's clients. Oh, did you owe ABC $50,000 on the receivable as of 12/31 of 20? Or on the payable side, did they owe you? Did ABC LLC owe you $75,000 as of 12/31 of 20? Here's another confirmation letter that's huge when it comes to an audit. George, the independent CPA, will send the letter, the confirmation letter, to ABC LLC's, Bob and Sue's company's attorney to verify, number one, is there any legal issue or issues impacting the company? Number two, and the attorney she has to sign off on the form. A lot of them don't want to do it, but they've got to. Number two, if there is any legal issue pending, in the attorney's legal opinion, could it in a, and this is the actual phrase, quote unquote, in a material way impact this client's financial condition, meaning ABC LLC, and their ability to repay the debt from, in this, in our mind, the debt, in the CPA's mind, just will it in a material way negatively impact the business, not repay the debt. That's our mentality. But George is just general. In general, could it, in your opinion, from a legal perspective, attorney at law, could it in a material way negatively impact the business's financial condition? Okay. If there's equipment involved, the CPA will also check VIN numbers. If it's a moving, if it's a titled vehicle, like a pickup truck or some sort of other vehicle. If it's like earth moving equipment called yellow iron for short, slang term, there's not a VIN number, but there's a serial number, if you will, on the, and usually it's like a little silver color metal tag on the equipment. Just a thought. Moving right along. Okay, I need to ask, Saptarshi, what level of reporting do you at MBC usually see? What's your most common level? Company prepared, CPA compiled, CPA reviewed, or a full CPA audit?
We get a mixture of both, depending on what type of business we're dealing with, whether it's a church or.
Okay.
But usually we get amalgamation of all types of statements. So.
Okay, but if you had to pick out of this list, company prepared, CPA compiled, or compilation for short, CPA reviewed, CPA audited, what is the most common of the four?
I'd probably say CPA review.
Really? That high a level? That high a level? Interesting. Aleem, how about in your area? Because somebody, I mean, I know you all work for NBC, but Aleem, what about you? What's the most common? If you
get the, I get to work with a lot of compiled statements.
Okay, so
but
yours
I
is
recently worked with a few loans that had audited as well.
okay,
So
but you're saying CPA
mostly
compiled,
compile, yeah.
compiled, not review, compiled. Thank you, Jeremy. What about you in your area of
And
NBC?
sorry to cut you off on that. It's, we get company prepared too. So it's a mix of compiled and company prepared.
Okay, so Aleem's world is mainly company prepared and the lowest rung and CPA compiled. Saptarshi's is more reviewed, higher level. Jeremy, how about you? We'll do one more. Jeremy, what about you? What is your most common?
Yeah, and one thing I would say to that too is I feel like sometimes they're a little loose on the terminology. Like we might get something they call company prepared or company prepared, but it has a CPA kind of looking through it, or there's the name of their accounting firm on the document. So I feel like sometimes, like a lot of the times we would refer to them as company prepared, but I would think that the majority I've seen are more along that CPA compiled.
Okay, CPA, which is good. Now those are higher level. Of course, I don't mean to speak out of school, but you are all based, besides Aleem in Nashville area market, you're all based in Ann Arbor or Detroit. You're in the metro area. When I work with commercial lenders, that in some states, I mean, they're in little tiny farm towns and, or other areas, small manufacturing towns or whatever. And it's almost some banks, some lenders, it is almost exclusive company prepared with maybe a few compilations and rarely a reviewed, and maybe in the entire bank, literally 2 or 3 clients audit. I mean, seriously, the entire bank. But the vast majority is just the lowest level. Interesting. But I do find this true. And I believe there's a correlation. If you're more in the metro area, it's a little more sophisticated, a little higher level of reporting. Moving right along. Thank you. That was excellent feedback, input. So the word of the wise. We push, and what was mentioned before, boy, sit down, try to help the company, encourage them to improve their reporting, even if it is company prepared, but improve their usage, for example, of QuickBooks. Encourage them to train their people, you don't want to get into hire this person, fire this person. You don't want to delve into what's called the double L, lender liability. We don't want to tell them what to do. We just want to encourage them to have more and more improvement or increase in their level or sophistication of reporting. Moving right along. Page number 6. Now back to Leblanc. We've done that little snippet on accounting, which is huge, huge, because we want good, solid underwriting and good, solid underlying financial statements. Okay, we're going to start on this, then we'll take our first break in the morning. By way of definition, if you put this in, we'll just restate it. Liquidity, the company's ability to service short-term obligations, less than 12 months, or another way to say it, the nearest to cash, if you would put that definition again. We're going to look at 3 calculations: working capital, current ratio, quick or asset test for all 3. And then, like we're going to do on each of these models, we're going to cover the basic key ratios. And then when we say adjustments, we're going to go to a higher level. We're also going to use our case study in just a moment called Schneider Corporation. Schneider Corporation is a small manufacturing firm right outside of Ann Arbor, Michigan, in an industrial park, light manufacturer, and it's owned by one individual. His name is Sawtooth Schneider, Schneider Corporation. He originally went to Ann Arbor to go to school, but he's not from Michigan. We'll come back to Sawtooth, the owner, on his personal side in just a few minutes after the break. So before we jump in, let's go ahead and take a 5-minute break and we'll come on back. Excellent, everyone. Excellent. Talk to you in 5 minutes. And what I would do, please, everyone, on these breaks, including a lunch break, I would keep your system up on your computer and then just mute yourself. But as soon as you come back, if you'd please unmute, that would be great. Talk to you in 5 minutes. Thank you. Welcome back, everyone. Take just a moment. We will get started. Okay, Amy, are you back with us? Amy, are you back? Wait, take just another moment or so. Everybody, if you'd unmute yourself, please, that'd be great. Okay, Ben, are you back with us? Ben, are you back? Okay, wait just a minute more. Everybody come on back. Okay, Ben, are you back with us?
I'm back with you. Dave.
Okay, great. Thank you for doing our, our sound check. Okay, welcome back, everyone. Now, working capital, you can see the formula. Current assets minus current liabilities, it's a raw number. If you please put it off to the side, $500,000, $500,000 off to the side. Okay, now, current ratio. Current assets divided by current liabilities, off to the right of that, if you put 2.0 as an example. How do you interpret a 2.0? For every $2 of current asset, there's $1 of current liability. Even though it's a 2.0, it's 2 to 1. Quicker asset test ratio. Current assets minus inventory divided by current liabilities. If you put a 1.0 to the right. Okay. Now, why do we chop out inventory? The reason we chop out inventory in this third one is it's considered the least liquid of the current assets. I would put a little note to that. The least liquid of the current assets. Now, on the surface, if you have these numbers as of 12/31 of 20, $500,000 working capital for a small operating business, 2.0 current ratio, 1.0 quicker asset test ratio, most people would say there's pretty strong liquidity. Would you agree with me, Mike? Would you agree? Most people would say, hey, that's pretty strong liquidity. Saptarshi, what about you? Saptarshi, are you there?
Sorry, David, I was having trouble unmuting.
Oh, no problem. Oh, no problem. Everyone's back. Everyone's back. Okay.
Yep.
Saptarshi, if you saw these numbers for 12/31 to 20 for a small operating business, is this correct? You'd probably say, oh, that's pretty good liquidity.
That's pretty decent. Yeah.
Okay, it's pretty decent. But do you really know? You don't, because you only have 1 year of performance. Everyone, if you would put at the top right-hand side of this page, put at the top right-hand side of this page, if you would please, 2 general rules of thumb that we're going to use on all 5 steps of the Leblanc model. Step number 1 on the top right-hand side, self to self. Step number 2, self to industry. Self to self and self to industry. What do you mean by self to self? Well, instead of just having 1 year, 12/31 of 20, you would actually have year-end 18, year-end 19, year-end 20, and even 3/31 of 21. Self to self is the trend of the company relative to itself. Number 2, general rule of thumb, top right-hand side of this page, self to industry. You use, for example, the RMA studies, Risk Management Association studies, or some other legitimate industry resource or study. Aleem, do you at MBC, do you use RMA or do you use some sort of industry source for industry studies to do your comparisons?
We do. We usually pull that off from SageWorks, where it gives
Okay,
us all the
and
industry.
that is that. I knew you were going to say that. That's one huge benefit of SageWorks versus Moody's, is that SageWorks captures the related companies within that particular code or that particular area. So you have automatically built into their system comparatibles. Aleem, do you ever use RMA? A lot of commercial lenders also use RMA, even if they have SageWorks. Risk Management Association, or RMA for short. They have an online service, and they even have a hard copy book. And believe it or not, some lenders, some banks will have both available. It's kind of nice to have that hard copy. You can kind of thumb through it and or the online. Do you use any other sources like RMA? Is it strictly the industry comparisons relative to or within the SageWorks system?
I have only used that for the time that I've been in
Okay,
NBC.
that's
I'm not
mainly,
sure if they were
okay.
using something before.
Okay. All right. Jeremy, have you ever used anything beyond the industry comparisons of SageWorks? I was just curious.
I've started using CoStar a little bit for some things for
Okay. I've heard of it. I haven't seen it. I've heard of it. Good. Amy, how about you? Have you worked with any other industry comparison, platforms or
No, just SageWorks.
just the SageWorks? Okay. Ben, how about you? Have you used any outside of SageWorks?
I think there was a Moody's product that I used once when I was in
Okay.
corporate banking.
Gotcha. Okay. Mike, how about you? Any others besides SageWorks?
No, I've just used SageWorks.
All right. Septarshi, any others?
Nope, just SageWorks.
Okay, got it. Okay, now, self to self, self to industry. Let's go to the current ratio. By the way, the 2.0 and the 1.0 for the quicker asset test, those are old-fashioned rule of thumbs, not the two general rules of thumb at the top right-hand side of the page. But these are two general rules of thumb that if you have a current ratio of 2.0 or higher, you have strong liquidity. Or if you have a quick ratio of 1.0 or higher, you have strong liquidity. But let's refute this. Let's say as of 3/31 of 21, first quarter of 21, the operating business has a current ratio of 2.0. Now you may be tempted on the surface to say, hey, they've got at least moderate to strong liquidity, because that's an old-fashioned rule of thumb, 2.0 or higher strong liquidity in the current ratio, like the quicker asset test 1.0. Seriously, those are, I would add and put a little note, those are the old-fashioned rules of thumb for these two. Working capital, there isn't them because it's a raw number. Now, let's go back to the 2.0 as of 3/31 of 21. You may be tempted in your loan write-up, your credit memorandum, to actually put, oh, strong, or at least moderate to strong. But what if you go to the two general rules of thumb, top right-hand side of the page, self to self, you go back to year-end 18, 19, 20, and 3/31 of 21. And they started 12/31 of 18 at a 3.0. Year-end 19, they dropped to 2.5. Year-end 20, they dropped to 2.25. 3/31 first quarter of 21, they dropped to 2.0. Self to self, they have deteriorated. Number two, self to industry. What if for this particular industry, the typical current ratio is a 2.6? Whoa. They started way above. They were at 3.0, but now they're down below. Self to self, they've deteriorated. Self to industry, they've deteriorated. Negative, negative. Wow. Now, I'm going to say it straight out. No names mentioned. My old boss at Bank of America, our team leader. He managed kind of like I did later when I became a team leader. He managed a portfolio, not as large as ours, but just like I did, but he managed a portfolio. So he was underwriting and, presenting and so forth, and loan committee and what have you, but he was mainly the manager, but he did have a portfolio of loans. If he wanted to get the deal approved, and just using model number one, liquidity of the 5-step laylock model, and he saw for 3/31 of 21, first quarter, if he saw a 2.0, even if the trend was down, self to self, and compared to the industry down, self to industry, he would, in his loan write-up, in the category of liquidity, say, He would literally say the company's liquidity was moderate. And he knew that credit administration, reading all these loan write-ups, didn't have 2 seconds to their name every day. And they would just look at it and say 2.0, well, no, that's actually strong. So he would say it's moderate. So they would think it, well, actually it's strong. And they would just move forward, turn the page, read through, boom, done, sign off. Knowing that the true trend of the company's liquidity was weak. Why? Because he wanted this deal approved. Oh, if he didn't want the deal approved, if he wanted to decline the deal he would do just the opposite. He would look at it and say, oh, you know, self-to-self deterioration, oh, self-to-industry deterioration, oh, way low. He was noted as a very creative underwriter. I say that tongue in cheek. He would even tell us, well, I like this guy. I'm going to, and his numbers would reflect it. Moving right along. Now let's go to a higher level. Look at prepaid expenses. Prepaid expenses per GAAP, generally accepted accounting principles, prepaid rent, prepaid insurance, as an example. Okay, now, I'd add this to your notes right below, prepaid. Per GAAP, these are current assets, prepaid. But will they ever convert to cash? No way. So if you're spreading the numbers, you take the prepaid, drop them down to other assets, out of the current assets. By doing so, all three of these calculations will be up above, will become more conservative. What about due from officers, shareholders, and employees? It's an asset, a current asset. Bob and Sue have borrowed from their own business. Or what we're going to see, Sawtooth borrows from his own business. He owns the business. It's a current asset. Well, more likely than not, the business owner, if they borrow from their business, it's a current asset on the bank, not the bank, the business's books. But it's never going to convert to cash. Why? Because the Bobs and Sues of the world say, well, we don't need to repay that. We own the company. Give me a break. What about employees? A receivable due from an employee. An employee has taken what's called a payroll advance loan. And it mushrooms, and a couple months later they do it again and they don't pay it back. And then they leave the employee of the company, or they're fired, they're terminated. You see a receivable due from an employee as a current asset, boom, you're spreading, Sage works, boom. A lien, you just drop it right down as other asset. Absolutely. Why? It's not going to convert to cash, most likely. Questions. Let's move forward. Here we go. Our first of our two major case studies, Schneider Corporation, as I alluded to a moment ago, small manufacturing firm right in the Ann Arbor, right outside of town, small light manufacturer owned by one individual, Sawtooth. His nickname is Sawtooth. Sawtooth, that's a weird name. Schneider. He arrived, well, how do you get to Ann Arbor? University. Came to the university. He actually was an engineering major. Mechanical, ME, not EE, electrical or civil or whatever, mechanical engineering major at University of Michigan, Ann Arbor. Started this firm. He got out of college. He worked at a local firm and he had this opportunity because he worked with this gentleman, older gentleman, and the gentleman basically groomed Sawtooth to take over the business and eventually sold it to him. And they were like family. The older gentleman's passed on. 18, 19, 20, actual year ends. These are not in thousands. What I'd like you to do is spend just a moment, look at these numbers. Page 7 and page number 8. And then take a moment and look at these numbers. Just the balance sheets and the income statements. So everyone take just a moment and look at these. We're going to look at these or use these numbers extensively. Do the entire Leblanc model using this case study. Go ahead, take a moment. Look at just, we've got on the balance sheets here on page 7. Pardon me, we have the assets, the liabilities, we have the owner's equity. Page number 8, of course, the income statements. We have the sales, the expenses, we've got the, sales or revenue, we've got the net income, so forth. Look at that middle year. Whoa, 19 lost. Whoa, tough year. We'll come back to that. We'll discuss it extensively in a moment. Take just a moment more. Review pages 7 and page 8, please. Take just another moment on this. Just a quick review, just like you would, working on any deal. You bet. Okay, here we go. We've got the assets, we got the both current, long-term or fixed. We've got, look at down into the liabilities and equity. Payables, notes payable. Look at long-term debt and look at the changes. Now, please look at the bottom left-hand side of the balance sheets here. Common stock, 460, 460, and 1,680,000, almost 1.7 million. What happened? Sawtooth sold off part of his business between 19 and 20. What? Look at that. He raised 1.2 million. Okay. That is significant. I put a little note off to the side. Okay. I'm going to ask a couple of you, how much percentage of this small business could he sell off and still retain control? Typically, how much percentage of the business could he sell off and still retain control? Elaine, what percentage could he sell off, and then what percentage would he keep, still maintain control of the business typically? Elaine? Jeremy? Jeremy, are you there? Jeremy?
I would think that he could sell up to 49% of the business to keep 51.
You were right on. You were right on, Jeremy. If you put that at the bottom of this page, he could typically, now technically he could sell off, 49.99, whatever, but typically 49 and he's 51. Now, he most likely, now let me ask you, Jeremy, what software do you use for your loan documentation? Do you use Laser Pro?
Typically, we get the templates out of SageWorks and then complete them off of there.
But I'm talking about the actual loan doc. So maybe you don't work with that.
I think it's Laser Pro.
It's Laser Pro?
Right,
Okay.
yeah,
Yeah, I believe so as well.
Amy, it's Laser Pro? Okay.
I think so. It sounds familiar.
Okay. Yeah, most banks, most credit unions, dominant Laser Pro. Okay, now, this is huge for you to understand, in my opinion, as underwriters. Because a lot of underwriters, well, that's the other part of the bank or the other part of the lender. I don't really touch the docs, but you should be aware of it to understand the full kind of the connection here. Sawtooth has violated a major covenant in the Laser Pro docs, specifically in what's called the business loan agreement. The business loan agreement. Okay. In the business loan agreement, there is a standard clause that is what's called a negative covenant. There's some positive covenants. Covenant is a solemn promise between two parties, Sawtooth and the bank, basically, or Schneider Corporation and the bank. The an example of an affirmative covenant. Affirmative is he will provide the bank with annual tax returns, annual financial statements. An example of a negative covenant, he promises not to sell off any part of the business without the bank's approval, the lender's approval. Well, he did it anyway. That's the negative. The positive is look what he used the money for. Look at the long-term debt. And by the way, all of the scenario we're talking about is going to be reflected in several of the different key ratios you'll see in just a moment. That's why we're talking about it. Look at the $1 million long-term debt drop down to 500. Look at the short-term notes payable from 720 down to 300,000. Well, so he was, the negative is he blew our covenant. The positive is what he did with the money. Okay, I'm going to ask a couple of you. Instead of taking the money and paying down debt, conservative, he played it conservatively. So on one hand, as the lender, we're angry. He blew our covenant. He didn't tell us what he was going to do. On the other hand, he played it conservatively, reduced the company's debt extensively, the leverage, which we'll come back to in our third model in a moment. Now, instead of doing this, he could have taken the 1.2 million, gotten on a plane in Detroit, and flown to Vegas. How quickly, Ben, how quickly could Sawtooth spend 1.2 million on a Friday night in Vegas? How quickly, Ben? Just tell us how quick could he?
I mean, if it's a fight night or NCAA tournament, let's say real fast.
Real fast, I agree. Mike, how about you? He flies to Vegas. How quick can you spend 1.2 million in Vegas?
Well, I've never been to Vegas, but I would imagine within like 30 minutes.
You were right on, Mike. In fact, we have several locations in Vegas, numerous, where every bet is $1 million. He could have spent that on one bet. I'm serious. Even if he was just playing, pretty high stakes, where every bet's, 10,000, 20,000, 50,000. Oh, in a given evening, it may take him 3-4 hours. He's done. 1.2 million. But there are certain places where every bet is $1 million, and there will be people that will play all night long. Oh, they'll lose 50 million in a night. They'll lose 100 million in a night. Oh, easy. $100 million in a night. You're going, no way. Oh, yeah. These people have flown in from all over the country. These people are multi-billionaires. 100 million, 50 million. That's nothing. Seriously. I'm serious when I say this. But he didn't do it. Look at this. Conservative. Okay, let's turn to page number 8. You reviewed page 8, the income statements. Look at 18, look at 19. 19, he took on 2 major projects. He bid them wrong. He didn't do it. It was his estimator. He's got an estimator that will do, or bidding manager that will bid these projects that they, because they're light manufacturing. By the way, what type of manufacturing do they do? Primarily injection plastics, high-end plastics. So they lost in 19. Look at the number. Look at the loss. What about 20? Whoa. What about 20? This is the pandemic. What? Well, wait a minute. Soon as COVID hit, they started manufacturing the plexiglass. Now, they already did some plexiglass. There was some usage for it, but it went off the chart. Now, it has slowed down in 21. It slowed down some. But they look at the numbers. Look at the sales growth from 19 to 20. Look at the net profit in 20. So some businesses decimated because of COVID. Some just hanging on. Some look at this. Here's another example of an industry that's even in the middle of the pandemic has just gone off the chart to the positive. Residential real estate. Saptarshi, in your area, you're in the Ann Arbor area. Is residential real estate off the chart high? Has it just gotten ridiculous?
Oh yeah, I mean, on the Ann Arbor campus, there used to be pizza stores that are now being, taken down, and there's just high rise,
Oh, you're
student
kidding.
housing. Just
Wow,
going
you're
up.
kidding.
Yeah.
Amazing, amazing. Now, he realizes, Sawtooth realizes, this is short-lived to a degree. It's, but there's going to be some need in the future, but not nearly enough. But, they still have their mainstay businesses, clients, most of them from before the pandemic. Now let's look at the industry comparisons. We're going to use these momentarily. If you'd highlight current ratio and the 2.7 to the right, quick ratio and the 1.0 to the right, inventory 6.1. If you highlight all of these, please, or circle them. Days sales outstanding is the same thing as AR turnover, and it's 32 days. AR turnover. Debt ratio. Do you see the debt ratio? 2.0, if you'd highlight that. EBITDA coverage and the 2.0. And then lastly, profit margin 3.6. Pardon me, 3.6. And we say profit margin, I would add this to your notes. This is huge. When you see profit margin in most industry studies or comparisons, they generally mean net profit margin, not gross profit margin. Just to clarify, they usually mean net profit margin. Okay, we're going to use each one of these as we go through the models. The 5-step layout model using Schneider Corp. Now let's move forward. Let's go ahead on page number 9, pardon me, and build a table if you would. Right below Schneider Corporation, if you please put 18, 19, 20. There, we don't have the interim 3/31 of 21, but we got the full year ends. So on the horizontal, right below Schneider Corporation, 18, 19, 20, and IND for industry. Okay, and then vertical, right below the S of Schneider, kind of just to build the little table. If you'd please put W/C, C/R, and Q/R. Working capital, current ratio, quick ratio. Okay, what I'd like you to do is to go back to page 7 and 8. This is specifically page 7. And use the formulas. Now, if you have the ability, you may want to take page 7 and 8 out. If you've got in your hard copy stack, you can take it out, or somehow, I don't want you to rip it out, but somehow if you got it in the binder already, take it out so it's easier to work the numbers, because then you got the numbers for Schneider Corporation, and then just keep the main PowerPoint together, these pages with the 5-step model. But go ahead and use the financial statements. In this case, of course, and use the formulas from back earlier and complete the chart, filling in this chart, if you will. Okay, take a couple of minutes on this. Grab your calculator, your cell phone, your freestanding calculator, and or if you've got Excel up and running, you can even use Excel just to crunch the numbers. But everybody, and then put the results right here in the chart at the top of page number 9, under number 1. Take another couple minutes and go ahead and complete the numbers. We'll come back together. You may say, oh, we don't do this. No, we let Excel, or not Excel, we use SageWorks to do this. Or some banks, small banks, they don't have SageWorks or Moody's, they use Excel. But no, the idea here today, manually crunch. Excel, that's fine. You could do Excel spreadsheet, that's fine. But it's mainly so that we get used to really understanding the input and, of course, the output. Detailed. One last comment while you work on this. I've had some, especially new credit analysts that come right out of school into the banks or other lenders, and they're taught how to spread the numbers, but they don't have a background in the actual input. So it's like, well, I'm taught how to spread the numbers, and the software does all of this. Well, no, today we're in the numbers. Go ahead, continue, please. Okay, Aleem, are you done with on the chart? Are you done with the numbers?
Just on the quick ratio.
Okay, keep going, keep going. Take just another moment or so, everyone. Excellent. Just keep on, I know there's a lot. And also remember the industry, IND, there's no industry comparison for working capital, so you put an NA not applicable, because that's a raw number. But remember, the current ratio for this case study for Schneider Corporation is 2.7, and the quicker asset test, is a 1.0. Okay, so you've got those from page number 8, previous page. Okay, Jeremy, do you have all the numbers?
I believe so.
Okay, Jeremy, would you please give us the working capital for the 3 periods, please?
I got 642,400 for 2018, 617,842 for 2019, and 1,640,312 for 2020.
Correct, all correct, excellent. Amy, how about you for the current ratio for the 3 years?
For 2018, 2.3, 2019, 1.5, and 2020, 2.6.
Good, and those are rounded, which is fine. Excellent, thank you, excellent. Ben, how about you for the quicker asset test?
0.85 for 2018, 0.5 for 19, and 0.93 for 20. Excellent,
excellent. And we have for the industry comparisons, current ratio 2.7, quick or asset test 1.0. Okay, now, excellent calculating, all accurate. Right to the right where it says comment on the company's liquidity. I'd like everyone, look at self to self, look at self to industry. Comprehensive judgment call. Strong, moderate, or weak. Would you say Schneider Corporation's liquidity is strong, moderate, weak? This operating business, small manufacturing firm in the Ann Arbor market. Strong, moderate, weak, or you can, and not only this, but all 5 steps of the Leblanc model today. You can do a hedge, moderate to strong, strong to moderate, moderate to weak, weak to moderate, little hedge. Take just half a minute, make a decision, and write it down if you would. please. Okay, here we go. Mike, what is your judgment call? Strong audit or weak, or a little hedge in between?
I'm gonna go weak.
Weak. Thank you. Saptarshi? Saptarshi, what would you say?
I would say weak to moderate.
Weak to moderate, a little different. Aleem, how about your interpretation? Remember, calculating is one issue. Whoa, interpreting, we bring this to a much higher level. This whole discipline today. Aleem, what's your call on this?
Looking at the industry and the ratios that we had, I would say it's weak.
Weak. Jeremy, what would you say on this one?
I think it's weak, moderate, improving, but like you mentioned, 2020 is kind of a one-off year, so I think you need to keep looking a little further.
Okay. Okay, good, excellent. Okay, now we're going to shift from those were all excellent, excellent interpretation. I mean, can you argue some of these back and forth? Absolutely. Now we're going to look at the related. Remember, not all the steps of the 5-step layout model, but several of these we will do the related. Here we go. Jim Sawtooth Schneider owns the business, 100%. He's not originally from Michigan, but he's been there. He's been in Michigan 20, 30 years, went to University of Michigan, so forth. ME major. Where's he from? He's from the Western US. His nickname comes from the mountain range of the town where he is from. The town is called Sun Valley, Idaho, a famous ski town. The mountain range is called the Sawtooth Mountains. Seriously, it really is. You can look it up. Everyone calls him Sawtooth. I mean, his real name is James Snyder or Jim Snyder, but it's Sawtooth to everyone. His CPA, George, he has the same CPA as Bob and Sue. Bob and Sue, non-competitor. Bob and Sue's ABC LLC, different manufacturing plant, different manufacturing firm. Schneider Corp, plexiglass, no, theirs is different. They actually tie into the auto industry as a specialty provider, meaning ABC LLC. Not Schneider Corp, no, different. His CPA, same CPA, George says, Sawtooth, you have $205,000 in liquidity. But does he really? No way. At least not from a commercial lending perspective. Off to the right of cash, we're going to do a little activity in that blank spot. Pardon me, to the right of cash over on the blank spot, if you would put, and then one line up, if you put a percentage sign. To the right of the word cash, over to the right, one line up percentage, and then over to the right to that, a dollar sign. So a percentage and a dollar sign. Now I want to emphasize, we are not taking any of these assets as collateral. If you look at the little footnote at the very bottom of the page, now this is part of Sawtooth's financial strength personally as a guarantor on our deal, like tertiary, third source of repayment. Okay. And Sawtooth, he remember, he's got a mathematical background. He's an ME, mechanical engineer, but he doesn't have a financial background. Okay. So he relies upon George. Oh, okay. He tells me I've got 205 in liquidity. I guess that's strong. Well, he doesn't. Let's do the first one together, and then I'm going to have you work on this individually, and then we'll come back together as a team. To the right of cash on the percentage, I put 100%. Most commercial underwriters would say, yeah, we'll put 100%. We're going to give them that much credit. Why? Well, we can look, we can see on our own bank. Well, on average, yeah, he has 25,000. Or if it's with another bank, he has 3 months of statements or whatever. We do 100% times 25,000 to the far right on the dollar sign. Once again, 25,000. what I'd like to have each of you do. What about the mutual fund? What percentage? What about the unlisted stock? What about the IRAs? You'll do the percentage individually and then do the math. And then at the far right, add up the column. Now, before we do so, I want to emphasize once again, we are not taking these assets as collateral. We're assessing the true liquidity, not the CPA version. No, the CPA just throws them in and, well, these are liquid assets. No, not from our perspective as commercial lenders. By the way, he's 55 and a half years old. Look at the IRAs. Look at the IRAs. Because he's below 59 and a half, if he breaks it, which he can do to satisfy his guarantee of our debt, there's a 10% penalty. Now, technically with the CARES Act, that's waived temporarily, but let's say it's not waived. So on the IRA, you've got tax plus the 10%. What percentage on that? Going back up to the unlisted stock, what percentage mutual fund? What percentage? We already know cash is 100% and 25,000. Go ahead, proceed forward. Do the analysis, including adding the column to the right, please. Take just a moment and do so. Make sure you add up the column that to the right. We're going to start with what's your total. We'll compare it. And then we'll go in depth on each of these others. Take just a moment more, please. Okay, here we go. Amy, do you have your number, your final number on the far right, on the bottom right? Amy, if you can unmute yourself, do you have your final number?
Sorry, I had to step away for a second. I'm not
Oh, no
finished
problem.
with
Oh, no
my
problem.
calculation.
Keep going, keep going, keep going. Take another moment, everyone. Go ahead and when you do the far right, add up your column. You bet. Okay, Ben, do you have a total number on the far right?
I do.
Go ahead, give us your number if you would, please.
88,750.
Okay, 88,750. Thank you. Mike, how about you? What's your total number on the far right?
I'm still working through it.
Oh, no problem. Take another moment or so. Take another moment. All you do is just take the percentage relative and then total them up over to the right. Okay, Saptarshi, how about you? Do you have a total number for us?
No, I'm still calculating.
Okay, keep going. Don't make this too deep. Don't make this too deep, but just, we know 100% on cash. What percentage on mutual funds? What about the unlisted stock? Well, unlisted stock is not stock on the New York Stock Exchange or the NASDAQ. It was Sawtooth has ownership in his friend's business around the corner. Just around the corner from a business, and they're friends, and hey, can you, I need some capital, and okay, I'll buy some stock in your company. That friend may have been one of the individuals that bought part of the $1.2 million of stock that Sawtooth sold off. Take just another moment or so. What's your total ending number on the far right? Okay, Elaine, do you have your total number?
I'm waiting for others to finish up because I want to see because I didn't
No,
get
no.
how
Oh, no. Don't show others. No, don't show others. Don't show others. No, this is individual. We're gonna talk.
Yeah,
Oh,
I
no.
know, but I honestly didn't get how we're kind of doing the percentage part. So I
Oh,
just wanted to see how
What
we're
it
doing
is, what this is, Elaine, is we're individually assessing liquidity. How
Yeah,
much
I
credit?
got that part.
Okay.
So I get it that it's 100% is for cash. Like we can, the cash is 100% liquid, and then we're doing how much is mutual fund and then
Yes,
IRA
you
and
bet.
then individual,
Okay.
right?
Sort of like an advance
So-
rate, Aleem, like how much would you lend against that?
No,
Yeah,
not
I
lend.
got that, but
Yeah. Well, let me
no,
clarify.
I think what Ben is saying is that he's trying to explain me. I think I got his point, but I was just kind of, because to me, unlisted stocks are not that liquid, so I didn't know what percent to put for that.
Oh,
So
gotcha.
that in that
Okay,
sense,
so,
yeah.
and keep in mind, we're not lending on any of these assets.
Yep.
We're assessing Sawtooth's ability to liquidate these, and it becomes part of his guarantee. If he has to step up as the guarantor and make some of
we are
these
lending
payments.
against it then. because-
Well, in that way we are lending against it, but it's his ability to liquidate and how quickly and so forth. But it really becomes the tertiary support. Okay. Jeremy, what's your final number to the far right?
I said 25,000. I don't think any of those
25.
are like
20, okay,
like-
25. Amy, what's your final number?
77,500.
Okay, 77,000 and change. Ben, what was your number again?
88,750.
88. Mike, what's your number?
I would go with 40.
40. Saptarshi, what's your number?
I got close to 25,000 like Jeremy. I don't know if that's right.
Well, say that again. It was closer to what?
25,000.
25. Okay. And Aleem, do you have a number for us?
Yeah, I had 42. So
40 also.
40,000.
Okay. 40,000 also. Okay. Now, these are conservative. This is good. I gave this to a group just the other day, and average person in the class said 125, 140. This is, you're conservative underwriters. That's good. Now, 81,250. Now, some of you were right in there. There was an 88, there was a 77. You're right there. Now, could you debate these? Absolutely. Let me walk you through how I got the 81,250. 100% on cash, 75% on the mutual fund, which would be 11,250. Unlisted stock, 0. I've had some lenders say, oh, no, it's 50%. Now, even if it's valuable, it's a timing issue with liquidity. And IRA's 50%, 10% penalty, plus upwards of almost 40% possibly. That could vary, but usually about 50% on the IRAs. Okay, when you do the math, 81,250. Like I said, several of you were right in there. Few of
Hey,
you. Go
David,
ahead.
I've got a question for you.
Go ahead.
So for IRAs and for retirement accounts, couldn't they, if we were trying to collect and they ran out of their cash and mutual funds, their individual unlisted stock wasn't worth
Yes.
anything.
Yep.
Can we force them to we couldn't force them, couldn't they?
That is a very good question. Good point. The answer is we cannot force them.
So why would we?
Specifically, we can't. Let me clarify. We cannot force them to liquidate direct. We can't say you will liquidate this IRA. In fact, the IRAs and all retirement accounts are protected per what are called the ERISA rules. They are protected. IRAs, 401ks, all of those types of instruments. But if we are legally or we are pushing Sawtooth, he can make up his mind to do it. So we cannot directly, like for example, we're going way beyond what I want to go, but let's just say we get a legal judgment against Sawtooth, okay, because there's a default. The judgment cannot attach to the IRA, but that doesn't mean we don't push him to where he does it on his own. We cannot legally say, you will liquidate this IRA. No, that's off limits. But most Sawtooths of the world, when they get the message, you're the guarantor, we want you to step up, they can liquidate the IRAs. They have all the legal right to do it. Does that make sense?
I get that they can, but I guess if we're saying, you know, the loan is in default and we need money, why would he choose to liquidate it when he could just keep it in the IRA and keep it protected?
That is an argument for individuals that on this activity did either 25 or 40,000. They can say, hey, this guy can just quote unquote slang term blow us off and just say, I'm not going to give you that, or I'm not going to liquidate it, which is correct.
Well, that's no problem. Why don't you just go get us that money in cash? And then when he doesn't have wherewithal to do that, you end up in a court proceeding where it's like, let's say he becomes up for a bankruptcy event at that time. Well, then everything's on the table, including an IRA. I
agree. Plus, this is the other thing that happens. Is, and this, and I know this is, you know, you may say, well, that's a little touchy-feely, but remember the 5 C's of credit that we covered. I think we were together in the class, we covered the 5 C's. The 5th and final C is character. If Sawtooth is the type of character that we hope this person is, this guarantor is, and his company, Schneider Corporation, is, he would do that on his own. He would just say, well, hey, I got to step up. And this is protected, and he may realize it. And his attorney and or CPA may point that out, but he may say, well, but my character is more important. And you may say, well, does that really happen? It really does, believe it or not. I worked at one of the 2 community banks I worked for almost went under because the original management messed up the bank. The original chief credit officer of the bank was making loans over the table and receiving envelopes with green underneath the table, meaning cash, seriously. And he's getting paid off. Well, I was part of the cleanup crew. We had people default right and left. And believe it or not, after chasing people for months, they would, all of a sudden, we had one guy walk in out of the blue. I'm so-and-so. I'm thinking, no way. We just charged his loan off the week before, put it in the stack of, we're not even going to pursue him ever. He was scot-free. We didn't tell him, and he goes, well, so he started making payments. We didn't tell him his loan was charged off. He looked at us, my boss and I, and he goes, and we were part of the cleanup crew, the new management team that came into the bank. Well, we were in the conference room, and he just says, he goes, my conscience just bothered me. I owe you the money. And he started making payments, and he eventually just kept paying. So people do that, believe it or not. They don't always just, you know, I'm out of here, and guess what? Good luck. That IRA, you'll never get that. So $81,250 in this example. Now, before we move on, and we'll take our second break in a moment, we're going to conclude this activity. I'd like to have you write down right below, comment on his personal liquidity, 4 different other assets that you may see. And I'm going to ask you just to quickly put a percentage by each one of these or below each one of these. Number 1 is CVLI, cash value life insurance. CVLI. Most of you have seen it. The next one, a bank CD, certificate of deposit. The next one, a variable annuity, otherwise known as a VA, a variable annuity. It's like a form of a retirement plan managed by or issued by an insurance company. Pardon me. Number 4, a 1965 cherry red convertible Mustang. A 1965 cherry red convertible Mustang in mint condition. Those are the 4 assets. Please take just a half a minute and write down below each one of them, what percentage would you give it? What percentage would you give them? Okay, here we go. Jeremy, what percentage on the CVLI?
Sorry. I said 80.
80. Amy, how about on the CVLI? Cash value life insurance. What percentage?
I said 100%.
100. Ben, what did you say on the CVLI?
Same as Amy, 100.
80. Most commercial underwriters today use 100%, what Amy got. Most will use 100%. The reason why, this is the mentality. If you liquidate that CVLI, cash value, or it says cash surrender value, whatever, you'll get 100%. But I would put a little caveat in your notes, a little note. I would, if you really want to get more detailed, call the insurance company, because most insurance companies will have at least some, not penalties, but some fees attached. But most commercial lenders today, vast majority, nationwide, use 100% for the CVLI. Okay, what about the bank CD? Mike, what percentage?
I would say 100.
100. Septarshi, what percentage on the CD? I mean, the bank CD?
I'd also say 100 as well.
100 as well. Aleem, what about the bank CD?
I had 100.
Pardon me again?
I had 100.
100%. Okay, now,
Yep.
now we're going to split hairs. If the CD is at your bank, let's say you're the lender at the bank, I do 100%. But if it's in another bank, I do 90. Why? Pardon me, because if Sawtooth has to liquidate that, if he has to liquidate it, there could be a 10% penalty. So I do 90. Just a thought. Okay, here we go. Variable annuity. Jeremy, what percentage on the VA?
Yeah, it's a tough one. I don't know much about. I'm gonna say maybe 75%.
75. Thank you. Amy, what about on the VA?
I'm in the same boat as Jeremy. I don't really know too much, so I'm going to go with 75% as well.
Okay, thank you. Ben, how about you?
Go with 50%.
50%. Most commercial underwriters nationwide today, 50% on the VA, because it has attributes like an IRA, 401k. It's sort of it has some tax situations related to it and so forth. So most people would say 50%. Okay, lastly, the 65 cherry red convertible Mustang. Mike, what would you say?
I would probably say 80.
80. Septarshi, what would you say?
Yeah, I was gonna say around 75 to 80.
75 to 80. Aleem, what would you say on the Mustang?
I would say since it's a vintage car, the demand would be more so 100%.
You say it's 100%? Okay.
Yep. Given the demand and the
Demand? Okay.
yeah, I mean the vintage cars are kind of
Yes,
considered
you bet.
expensive.
If you'd all put in your notes, 0. 0, because it's on a practical basis, it can be liquidated overnight, but it's not the type of asset that most bank commercial lenders would acknowledge is liquid. Just like art, you know, the artwork could be liquidated overnight in theory. Now, depending on the price, I'd write the check myself. I'm just kidding, right? I go, oh, I want that Mustang. Okay, but 0 is the official. Okay. Moving right along. Let's turn to page number 10. Model number 2 activity. We'll stop right there. We'll come on back, take a 5-minute break. We'll come back and we'll do activity. Excellent. Excellent analysis, everyone. Very good. Very detailed. Excellent. Talk to you in 5 minutes.
Thanks.
Welcome back, everyone. We'll take just a moment. We'll get started. Okay, Amy, are you back with us?
Sure am.
Excellent. Thank you for doing the sound check. Okay, model number 2, activity. If you'd please add definition, swing factors or turn factors. They swing up, they swing down, they turn up, they turn down. 3 calculations in this model: AR turn, AP turn, inventory turn. AR divided by sales, time, we do that part of the calculation first, and then of course, times days in the period. If it's an annual financial statement, times 365. If it's semi-annual, times 180, 182. AP divided by cost of goods sold, or COGS for short, times days in the period. Inventory turnover, inventory divided by cost of goods sold, times days in the period. To the right of this, like to the right of accounts receivable turnover, and just one line up, if you'd please put 18, 19, 20, and IND for industry. Now the AR turn, we know industry, you can put 32 days. Remember days sales outstanding? AP, NA, not available, which is common. You're not going to always have, of course, in this discipline of key ratio analysis, all of the industry comparisons. Inventory turnover, as you look back on page number 8, is 6.1 times. Now this is in days, so when you do the calculations, don't get thrown off. We'll talk about it. We'll convert days to times so we can do a comparison to the industry. Everybody take just a couple of minutes and calculate all 3 of these for the 3 periods for Schneider Corporation, please. Take just a couple of minutes if you would. So I'll take, of course, use the formulas and grab the page 7 and page number 8, please. Take just another moment or so. Do all 3 of these, if you would, for the 3 periods, 18, 19, and 20. Okay, Ben, are you ready to go? Do you have them all?
Not quite yet, but I've just
Oh,
got.
no, keep going, everyone, keep going. Take another moment or so. Go ahead and complete all 3 of these for the 3 periods, if you would, please. And what I would do is I would calculate only to 2 decimal points. Traditionally, most of these are to 2 decimal points. Okay, Mike, do you have all of the numbers?
At least for a accounts receivable turnover.
Okay, okay. Can you tell us what do you have for AR rounded? If you'll round the days, go ahead. The 3 periods, the rounded.
Not sure if these are right, but 37.35, then 39.55, then 45.55.
Excellent, perfect. So rounded would be 37, 40, and 46.
Yep.
Completely correct, completely correct. All right. Take just a moment, everyone, to do the rest of this if you're still completing the table. That first one is complete. Good. 37 rounded, 40, and 46. And the industry is comparison is 32. Good. Septarshi, do you have AP turnover?
No, I'm still going through AP. So
Okay, keep going. So you just, with the AP, you take the accounts payable respectfully divided by cost of goods sold. So the AP there on the balance sheet, cost of goods sold on the income statement, do that calculation first and then times it by 365. Inventory on the balance sheet divided by the cost of goods sold on the income statement times 365. Good. Give you another minute or so. We'll summarize this. Okay, Aleem, do you have the numbers for the AP turnover? Jeremy, do you have the numbers for the AP turnover?
I believe so.
Go ahead, would you please give us those? And you can just round the numbers if you don't mind.
Yep, 18.56 days for 2018, 23.75 for 2019, and 22.64 for 2020.
Correct, all of it correct. So AP rounded 19 days, 24 and 23 days. Excellent. Okay, what about inventory turnover? Amy, do you have inventory turnover for us?
Yeah, hopefully I did this right. So for 2018, 91.1, 2019, 94.4, and 2020, 108.
Excellent. So 91, 94, and 108. Okay, excellent. Thank you, Amy. So we should have all of the numbers. Once again, AR turnover, 30s, these are rounded, 37, 40, and 46. AP turnover, pardon me, 19, 24, and 23. Inventory turnover, 91, 94, and 108. Okay. All right. Ben, are
What
you
was
good?
the industry average?
And say that again. I'm
What
sorry.
was the industry average for AP turnover? Did you
There
say
is
that?
none. There is none. NA not available. There is none. AR is 32. Inventory is 6.1. AP turn, NA not available, which, as I mentioned, is common to not have all of the industry comparison. Thank you, Amy. Ben, any questions so far?
No, sir.
Got it. Okay, now, before we do our overall assessment of Schneider Corporation's activity model 2, or pardon me, model 2 here, we need to convert the inventory into times. Okay, now if you have inventory turning every 6 times a year, that's roughly every 60 days. Okay, so, and this is common. especially with inventory, instead of it in days, it's actually in times, especially like a retailer, okay, or some other, even a manufacturer like Schneider Corp. Everyone for that first year, for 18, we would take 365 divided by 91 days. And if you'll put this in your notes right below the 91 days, it's 4.0 times. So 365 divided by 91 gives us 4.0. 2019, 365 divided by 94 days will give us approximately 3.87. And then the third one, for 2020, 365 divided by 108 will give us 3.38. So all we've done is converted days of the inventory turnover to times per year. 4.0, 3.87, and 3.38. Now we have a good comparison to the 6.1. Okay. Questions on that? Any questions on that? Mike, any questions on the conversion on the inventory from days to times?
Nope, that seems pretty straightforward.
You bet. Great. Okay, now we've got self to self on AR in the industry, self to self on AP, no industry, unfortunately. And by the way, in building this case study, I put that on there on purpose. Why? You're going like, whoa, whoa. It's because in real life, you don't always have the comparisons that just for whatever reason, sometimes they're just not there. And then lastly, inventory, self to self in days, and then self to self in times plus the industry in times. We want, by the way, pardon me, just to highlight, we want AR to shrink in number of days, quicker collection of the cash. AP, stretch it out a little bit, but don't get put on COD. Cash on demand, cash on delivery within the trade credit industry, trade credit, not bank, but like in the trade, the suppliers. Inventory turn, we want it to shrink in days, or the equivalent, we want the number of times to expand. Less number of days, times to expand, same concept. But look what's happened to inventory. It's expanded in days and it's shrunk in times. And look at the comparison from times to times 6.1 industry. Okay, here we go. Bottom of the page. Take a moment, look at self to self, self to industry. Give us your assessment at the bottom. Strong, moderate, or weak, or a little hedge in between. Strong, moderate, or weak, or a little hedge in between. Go ahead, spend just a half a moment on this, please. How would you rate Schneider Corporation's activity? Overall, strong, moderate, or weak, a little hedge, and it's a comprehensive assessment. The overall model of activity, combination of all three up above. Okay, Saptarshi, what is your comment? How would you comment? What would your judgment be? Strong, moderate, or weak, a little hedge in between?
I'd say it's average turnover, so moderate.
Moderate, okay, overall, not just one of them, but all three combined.
Right.
You're still moderate, okay. Aleem, what would you say? Strong, moderate, or weak, Aleem?
Compared with industry, I think it's weak.
Overall, comprehensive, you're saying weak. All right. Jeremy, what would you say? Overall assessment.
Weak, self to self and self to industry.
Okay. Combined, you're saying weak. Amy, what would you say?
I'd say weak as well.
Okay. All right. My opinion, I agree. I say weak. Moving right along now. We're going to do a tag-on model bring this is the basic. We're going to bring it to a higher level. Like we've said with several of these, boy, this is a higher level. You'll turn with me to page number 11. This is called the cash conversion cycle. Some commercial lenders miss this when they're analyzing the operating business. And this, in my opinion, is crucial. In other words, this is an extension of Model 2 activity. If you'll add the definition, cash conversion cycle is defined as follows. The average number of days that the company's cash is tied up in its current assets. Pardon me, it's defined as the average number of days that the company's cash is tied up in its current assets. Now look at the formula. Inventory in days, we just calculated it, plus AR in days, we just calculated it, minus AP in days. Okay. Everybody, if you will take your calculator for each of the individual years, okay, 18, 19, 20 respectfully, go back to the previous page. You've got inventory in days. Don't do the times, but in days, plus AR minus AP for 2018. Do the same for 19, the same for 20. And on page 11, if you'll plug it right where it says calculate the company's cash conversion cycle, I just put in 18, 19, 20. There is no industry, no IND. So right below where it says the task, I put 18, 19, 20. But just go back one page. You've got them there already. Inventory in days plus AR in days minus AP in days, respectfully, for the 3 years, and just plug them in there on page 11 if you would. Take just a moment, please. Okay, here we go. Mike, do you have the first one for 2018?
I believe so. I got 109.
You are right on. We'll round it to 110. Good.
Okay.
Excellent, Mike. Thank you. 110. Septarshi, what about the second year? Do you have 2019?
No, I don't.
Okay. So for 2019, you just take the inventory in days plus the AR in days minus AP in days. Okay. Take just a moment, everyone. Go ahead and finish 19 and 20, please. 19 and 20. You're just taking the numbers from the previous page that you already have. So inventory in days plus AR in days minus AP in days. And it's respectful, of course, respective for each of the years. Don't mix the years, just separate. Of course, each year different. Aline, do you have 2019 for us?
I got 110.
You're right on. You're right on. 110 is correct. Rounded. So 110, 110. Okay. Jeremy, do you have the third year yet? Do you have 2020?
Yeah, I got 131.
131 is right on the money. So 110, 110, and 131. Okay, now, is this good or bad? Well, let me give you the hint. The shorter we want this number over time to shrink. It went the opposite. Go ahead, just take a moment and read the note. You see the little paragraph in the middle of this page, please. This is the importance. pardon me, of the cash conversion cycle shrinking. Boy, Schneider Corporation, oh, no. It went the other way, the wrong way. Okay, we want it to shrink. Now, look at the bottom example. What if Sawtooth has a CFO? Sawtooth has a CFO named Mark. And Mark says, Sawtooth, our manufacturing process is 30 years antiquated. Boy, I mean, you came out of engineering school at the university down the street, University of Michigan, and you know, and he says it to him nicely, but you know, gets the message across. We got to retrofit. It's going to cost $100,000, but we got to do it. Let's say they do it, and they retrofit their entire process of the manufacturing in the plant, and they're able to drop the inventory turn in days from, if you remember, the last year was 108. From 108 down to 80 days. So to the left of number 1, bottom left-hand side of this page, if you put 80 days from 108, that's a huge improvement. But remember, they've been operating with the methodology from 30 years ago, plus more than 30. Under number 2, do you see where it says reduce the AR? We don't want AR stretching out. No, we want them to collect their payments quicker. Mark, the CFO, says, well, wait a minute, Sawtooth. Our receivables are stretching out, but our payables are too quick. He looks at Sawtooth and says, I think we have the right 2 people, but in the wrong spot. Let's switch the AP manager to AR to AP. Immediately to the left of number 2, if you'd put in your notes, AR, 30 days. The last number was 46 days. It was stretching out. Overnight, boy, the AR manager, she is so good. She gets that clamped down to 30 days. The old AR manager that's now the AP manager, boy, the old AP manager paying the bills too quickly. He inadvertently stretches out AP from 23 days, the last period rounded, to 35 days. To the left of number 3, I put 35 days. Okay, now let's do the math. We do the same formula from up above. Inventory plus AR minus AP, turn and all. So we've got 80 plus 30 minus 35. And you should arrive at 75 days. Okay, now look up above. 131 days was the last, and it was 110, 110. That would have been fine if that last one would have shrunk. Because remember, we would prefer cash conversion cycle to shorten. In reality, the company expanded dramatically, another 3 weeks, 21 days. But if you go down below, it's 75 days compared to 131. That's a 56-day improvement. 56-day improvement, almost 2 months. Once again, this is an extension of Model 2 activity, an extension, cash conversion cycle. The major gist is under the note in that paragraph. All those benefits by shrinking or shortening the cash conversion cycle. Any questions? Jeremy, any questions on this one? Any questions on this model?
Nope.
Got it. Amy, any questions on this model?
Nope.
Got it. Thank you. Let's turn to page number 12. We'll stop right there. We're going to take our lunch break. Okay. Let's come back at 12:35 your time. Take a half-hour lunch break. Come back at 12:35, and away we go. So and we'll come back and we'll go right into Model 3, then 4 and 5, and continue with the Leblanc model. Any questions overall before we take our break? Any questions? Great. Have a good lunch, everyone. Talk to you in a half hour. Thank you so much. Excellent, excellent calculating. Thank you so much for participating as well. Excellent.
Thanks.
Thank you. Welcome back, everyone. We'll take just a moment and we will get started. Okay, Jeremy, are you back with us?
I'm back.
Excellent, excellent for doing that. We've got one person missing, so we'll wait just a moment. Give us everyone a moment just to get back, and then we'll get started. Okay, here we go. Before we get started, let me just, if you wouldn't mind, if you could write this down on a separate piece of paper or off to the side. I'm going to give you the dates and the topics for the advanced classes coming up in September. Now, if we have enough people, this would be held in Lansing, most likely, and so they would be in Lansing. They're scheduled to be in Lansing. If there's a smaller crowd, of course, we would do the Zoom-based or webinar-based training. September 15th, this is a Wednesday, Thursday, Friday. September 15th, we have advanced financial statement and cash flow analysis. So that first one, if you would write that down, please. September 15th, advanced financial statement and cash flow analysis. That's on a Wednesday. Thursday, September 16th, advanced tax return analysis. So the advanced tax. And then on Friday, September 17th, we have the CNI in the morning, kind of the combo class. And it's once again, the CNI in the morning and CRE in the afternoon for that same session. So it's a combo of CNI and CRE, or commercial and industrial, and then of course commercial real estate lending in the afternoon, and that's on Friday the 17th. So 3 days in a row, all advanced, and there's enough people, once again, ground-based in Lansing. Otherwise, we'll do like we've done so far. We will do or like we're doing today, the Zoom-based. So anyway, I'd welcome each of you or other members of your team from the MBC that may be appropriate. That would be great. Okay, let's move forward. Model number 3, leverage. Now, define the definition of leverage. We said this earlier when we first introduced the Leblanc model. The company's ability to service its long-term obligations. So instead of we've got the long-term obligations is, of course, the leverage. Now, more, think in terms even of 2, 3, 4, 5 years out, instead of just, less than a year, we'd say over a year, but even further out than that. The main key ratio in this model 3 of the 5 steps, is the debt ratio, or debt divided by net worth. I put a little note next to debt, both current and long-term liabilities. Current and long-term liabilities. Okay, now, sometimes you will see this. And now I mentioned I trained the CPAs as well. Sometimes CPAs, not all of them, but a few of them, if you ever negotiate with a CPA, they may say, well, my understanding is the debt ratio is just long-term debt or long-term liabilities divided by net worth or equity. And you'd say that's one version of it. But most lenders, most creditors, most bank and other commercial lenders will use total debt. Okay, what I'd like to have you do is build the table. Right below where it says the task calculate the debt to worth for Schneider Corporation, if you'd please put 18, 19, and 20, and then IND. On the horizontal, right below, on the vertical, D/E, debt to equity. And we know from page number 8, the industry calculation is 2.0. So the industry calc or comparison, I should say, is 2.0. So go ahead, spend just a moment, everyone. We've got the formula. Grab page number 7, the balance sheets, and go ahead and calculate the 3 years for the debt to equity ratio or debt to net worth, same thing. Go ahead and proceed. Take just a couple of minutes on this, and we'll come back together and check our numbers and move forward. For those that are just joined us from lunch, we're doing the calculation for the debt to equity ratio for Schneider Corp for all 3 years. Of course, right there where it's right below where it says calculate, the formula there. So you'll take that, just go ahead and proceed. Take another moment or so on this one. Okay, here we go. Amy, do you have that first year for us?
I do. I got 1.21 for 2018.
You were correct. You were correct. Excellent. All right. Ben, do you have the second year for us? 2019.
I did, but then now I suspect I did it wrong.
Okay.
I was adding short-term debt in with that, the notes payable. That's
Yeah,
right.
don't that is common. That's a common mistake. But we only do, well, let me rephrase. We would take the current liabilities, which includes the short-term notes payable and the long-term combined. You bet.
Wait, so notes payable and long-term debt.
Yes, correct. Well, but also if you go back, hold your eyes, let me turn to page 8 or page 9, or pardon me, page 7. We would take the current liabilities. This one is already outlined, plus the long-term debt divided by the total equity. So we would take the easiest is just use, because it already spells it out, current liabilities plus long-term debt, combine those two together, divided by total equity. Okay.
So for 18, I got 0.79. I must be missing something here.
For 18 is 1.21. You bet. So you take the total current liabilities plus the long-term debt, do that calculation divided by total equity that's already outlined.
So you're including accounts payable in this calculation?
Oh, yes. Oh, yes. Yes.
And accruals?
Yes. Yes.
Okay.
All current liabilities. Like I said, some CPAs will say to me, oh, I was always taught it's only long-term debt divided by total equity.
Well,
not
I've seen
all
it done long-term debt plus current portion long-term debt.
And what that is, the current portion long-term debt is part of current liabilities. With lower level financial statements like these, you usually do not have the current portion long-term debt broken out.
Well, so right, that's what I'm tracking with you there. But so I assumed notes payable is the current portion.
Oh,
due for the
gotcha,
next 12
gotcha,
months.
gotcha. But you would use total current liabilities
Got it.
plus total current or total long-term divided by total equity. You bet.
Okay.
Okay. We'll wait just a moment more and we'll continue. Okay, Mike, what did you get for the second year? Mike, are you with us? What did you get for that second year?
Sorry, I actually had to take a step away. My cat just shoved a bowl off the counter, so I had to
Oh,
go
I'm
clean
sorry.
that up real quick, but
Oh.
I'm working on it now.
No problem. No problem. I understand. I understand. That happens. Boy, I'm telling you, we're with the pandemic and so forth, it's the world's changed. I mean, I understand completely. Okay, moving right along. Aline, what did you get for that second year?
I had 4.18.
You're correct. 4.18 is correct. Excellent. Jeremy, what'd you get for the third year for 2020?
0.78.
0.78 or just 0.78? Excellent, correct. So the three numbers, you should have 1.21, 4.18, and 0.78. Now, first off, why the swings? Well, remember I pointed this out to you that, Sawtooth sold off 49% of his business from 2019 to 20 and 20. And so in 19, he loaded up on the debt, well, just partly to cover his losses. Remember, he had that big loss in his profitability in 19. But then from 19 to 2020, why the significant reduction is because he sold off part of the business, took the cash, and primarily paid down on debt. So he basically took the cash that he raised from the sale of almost, for 49% of the business, and he took it and paid down the liabilities. So the debt to equity switched around actually to the positive. Unlike liquidity, like for example, the current ratio, the more the better. The more is the better. With leverage, the less is the better. In fact, if you would add this to your notes somewhere off to the side in the middle of this page, old-fashioned rule of thumb for this particular calculation or key ratio is a maximum of 3.0. A maximum of 3.0. For every $3 of debt, $1 of equity. For every $3 of debt, $1 of equity. Well, most of the debt, besides the payables and the accruals, could be our loan. And of course, so it's really us versus them. It's like, well, we are the debt provider. They're the equity provider in the equation. So once again, the extreme improvement between 19 to 20 reduction, which is a good thing, is because he sold off part of the business. Now you can argue, well, he's not going to have that next year. Well, that would be the benefit of having an interim statement for 21 to see, does he maintain his low debt versus equity position? Unfortunately, we don't have it. And in real life, you may not have it always. Okay, so we've got the numbers. Also, under the IND industry, we know per page 8, back on page 8, the industry comparison is 2.0. So 2.0. So higher than the first year, obviously lower than the second, higher than the third year, what have you, but it's a 2.0. So we've got 1.21, 4.18, 0.78. So for example, 0.78 for every 78 cents of debt, there's $1 of equity. Back on the previous year, for every $4.18 of debt, there's $1 of equity. And then of course, industry comparison is 2.0. And then we know lastly, old-fashioned maximum generic with all sorts of industries, all different industries, a generic maximum of 3.0. This particular industry for this particular plastics manufacturer, Schneider Corporation, is 2.0. Okay, off to the side or right below the word comment, take a moment, everyone, strong, moderate, or weak, or a little hedge in between. What would you say? Is it strong, moderate, or weak, or a little hedge, if you will? Okay, take just a moment. We'll do the comment or the rating or the judgment call on this particular model for Schneider Corporation. What would you say, strong, moderate, or weak? Okay, Amy, what would you say? Strong, moderate, or weak, little hedge in between? Remember, the lower is the better, and you've got the scale.
So for 2020, I mean, it's looking strong, but it would be hard to say that it was strong for all of the periods because 2019 is.
This is tough because of the swings, the extreme swing.
Yeah,
overall,
so I would probably say moderate and then comment on the change.
Got it. Oh, I like the comment. I like your comment on the change. Absolutely. Ben, what would you say? Strong, moderate, or weak? Or a little hedge in between?
I mean, I think Amy got it exactly right. 2018 and 20 are pretty strong. I mean,
Yep.
And 2019 is no bueno.
But overall, what's your comment? Strong, moderate, or weak?
I'd say moderate, and I'd add
Moderate.
commentary.
Okay, thank you. Mike, how about you? How would you rate this?
I would rate it moderate and maybe put a comment that if we got 2021 and it was in line with 2020, like then it would be strong. But
Good.
just based on the 3 years we have, I would
I
say
like it.
moderate.
I agree with you. Put a little comment. Now, if we had 3/31 of 21, or even better yet, which is coming up at the end of next month, 6/30 of 21, 6 months. And if you see that same pattern roughly around 0.78, maybe it's a 0.80, maybe it's a 0.76 or whatever, you're going to say, oh, it's strong, because remember, the lower is the better on this one. And they maintained since the change was selling off part of the business. The worst nightmare would be you get the 6/30 statement at the end of next month, which is really in July, I should say, 2 or 3 weeks into July coming up. And all of a sudden you do the numbers and it's like they're now up to a 1.25 or 1.3. You're going like, wait a minute, they're heading up the other way, the wrong direction. And then you think, wait a minute, Sawtooth cannot sell off more of his business, because then he'll lose control. He's already sold off 49% in our hypothetical example. Wow. If he sells off more, he loses control. We can't have that. So that would be a real negative, in my opinion. If all of a sudden you see, oh, wait a minute, you're taking on debt beyond what it was at the end of 20. Excellent, excellent analysis, everyone. Now, let's bring it to a higher level. Adjustment. Subordinated debt. Okay, before we go into this adjustment or extension of the model, this third model, leverage or debt to equity, have any of you in your careers, respectfully, have you worked with subordinated debt? Any issues? Mike, have you worked with subordinated debt?
Yes, we have done. We've underwritten loans where we have to subordinate debt.
Okay.
Recently,
So you've seen a little bit of this. You've seen some.
Yep.
Thank you. Aleem, have you seen any issues related to subordinated debt so far?
I have not. I honestly, I don't remember if we did something recently, but I don't remember.
Okay. All right. Let's just go into this as an example. Thank you for the comments, by the way. Let's say that Sawtooth, instead of borrowing for the business we talked about earlier on the current asset, let's say that he lends to his business on the liability side. And let's say he lends $100,000 to the business. Okay. Schneider Corporation, it's a liability on this balance sheet. Now, if Sawtooth had a personal financial statement or balance sheet, it's an asset to him because he's lent the money to his own business, but the business owes him the money. Well, look at this adjustment. This is what we could do. We could, and this doesn't always happen, but this could happen. The bank or other lender says, you know, we want to really make sure our position is solid. We're going to have Sawtooth sign what is called a subordination agreement. I'd add that underneath subordinated debt. In Laser Pro, which is the most common software we talked about earlier that you look at, or at least your clients have, it's actually called a subordination agreement in the stack of documents. Okay. Now, what does it really do? What does it do legally? It puts that $100,000 that Schneider Corporation legally owes Sawtooth personally behind us, because they're signing off on this, or with signing this subordination agreement. And now Sawtooth is behind us. If Schneider Corporation falls apart, who is ahead of whom? We, the bank, we, the lender, are ahead of Sawtooth. Now, there's probably other creditors ahead of us. The lender or the bank, for example, the IRS or somebody else. But at least our relationship with him, he's behind us. If you would please add a little note further in this adjustment section, using the 100,000. If Sawtooth signs our agreement, in our key ratio for the debt to equity, we would take the 100,000 from the liability or debt side of the equation up above and add it mathematically to the equity or net worth side of the equation. We can legitimately do that because for all intents and purposes, that's equity. That's equity he's put in the deal because he's now subordinated or behind us, the bank. Does that make sense? Jeremy, does that make sense what I just said?
Yes, it does.
Good. Okay, now think of it this way. That's kind of what he did, sort of, when he sold off part of his business, is he took equity or he took dollars that he got from the sale and paid down debt, essentially. And that's why his debt to equity ratio dropped or improved so dramatically. Think about it. Okay, now, sometimes though, if you negotiate with the borrower or the lender negotiates with the borrower and they said, hey, we're going to have you sign a subordination. We want that note subordinate. Sometimes the borrowers will fight. Oh, no, 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 no. And they're not dumb. They realize they may not know all the technical, but they realize, oh, that means I'm subordinate to the bank. The bank's ahead of me. Every once in a while, they may argue, well, do you really need to do that? Da, 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 da. But sometimes some bank lenders literally just say in so many words, this is the way it's going to be. Like take it or leave it. You don't do this, we don't do the deal. Oh, okay. You know, sometimes there's more astute borrowers that understand. Some of them really don't understand, my opinion. I've worked with some both sides of the table as a lender and as a CFO today. And I said, well, the bank wants you to subordinate, like I'm their CFO or contract CFO. Bank wants to have you subordinate this debt. They don't really understand fully. They kind of understand that, well, the bank's ahead of me. Okay. And they almost like a guarantee. Yeah, okay, I'll sign it. Now let's go to the other. DTI. Some commercial lenders, not all, but some will also include in this section, model 3 of the 5 steps. They will put in this section a debt to income ratio, because from the personal, remember we on several of these, not all, but several of these models, we try to do the personal side. Well, The DTI gives an indication of how highly leveraged Sawtooth is personally outside of the business. Kind of like we did his liquidity outside of the business, same idea. Some commercial lenders do this, others don't. Others don't touch it. They say, well, this is more of a consumer loan concept. We don't want this in our loan write-up, commercial loan write-up. But some do. And they use it appropriately, kind of as a gauge of leverage of, once again, the business owner personally. Okay. Before we work on this key ratio, which is a tie-in to leverage, let's do a class shout out. Yes or no? Have you ever calculated a DTI in your career? Everyone just shout out yes or no. Please open the mics and shout out.
Yes.
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 Wow, most of you have. Good, excellent. Now, total monthly debt payment divided by gross monthly household income. So if Sawtooth has a house payment of $2,000 a month, pardon me, and a auto loan for $500, and then he gets another auto loan for $500, $2,000 plus $500 plus $500, $3,000 in the numerator. Gross house, and we don't put like, fuel expense, groceries, clothing, none of that. Utilities, no. Just the set monthly payments. Divided by gross household monthly income. If his gross household monthly income personally is $6,000 a month, 3 divided by 6, 50%. Pretty straightforward. The maximum at most banks, and I would add this to your notes, is 43%. The maximum is 43. Okay, let me ask, Amy, in your world, and I recognize that MBC, you work with multiple lenders, but have you had conversations or interaction with certain lenders where this has come up? Do you know what your max of at least a few of your lenders that you work with on the DTI? What is their maximum?
I don't think I've ever discussed any of that with any of the credit unions. It's just, I think, something we include in our analysis.
Okay, gotcha. So, but you've never said, well, wait, hey, by the way, what's your max as a standard? Okay, thank you. Ben, have you had that conversation ever with any of the lenders saying, hey, by the way, what is your max? You do the math, you're doing the analysis for them, and it turns out to be, 38%. Well, what's your max?
No, I mean, I think that in my experience is more like consumer lending a little bit. So we're cash flow lenders so we're primarily going to have discussions around debt service coverage ratios and ability to repay with.
So you haven't had this. Flows. Okay. All right. But like I said, I mean, average bank in America today, pardon me, the typical is 43% max. I had a group just last week. We had everything from 40 to 45. And I said, well, the nationwide average is 43. And we had several banks in the group that was 43. Okay. But 40 versus 45, the two, and then there were several at 43. So it can vary from bank to bank or lender to lender. Let's move forward. Model number 4 of the Leblanc model. Operating performance, here we go. We did the definition earlier, the profitability of the business or lack thereof. The profitability of the business or lack thereof. Okay, now, we common size the income statement. Now, this is just 1 year, of course. If you had 3 years or 3 years plus the interim, you do it for each of the periods. You can see net sales in this example, 5 million, 100%. Of course, your software, SageWorks, will do this for you. Cost of goods sold as a percentage of net sales, 88. Gross profit margin, 12. G&A, general administrative, the overhead, 7. Net profit margin, 5. I would circle or highlight, pardon me, the 12% and the 5%. These are the two most common that we would look at in this model, or ratios. Now, once again, just to keep it simple, there's just one period. In reality, you may have 3 year ends or 3 year ends plus an interim. So 3 or 4 columns. So you would pick up off the changes of the gross profit margin or percentage. the changes of the net profit margin or percentage, self to self, and of course, self to industry. Okay. Any questions on this one? Aleem, any questions on this one? On this model? We're going to do the math in just a minute, but any questions on the gist of this particular key ratio?
Not as of now.
Okay, got it. Okay, now, everybody, if you will please turn back in your hard copy to page number 9. I'll turn back. Don't look at the screen. I'll turn back to page number 8. I apologize. Page number 8. Turn back to page number 8. What I'd like to have you do is calculate. Let's do the key ratios on Model 4 operating performance. Okay. Now, for gross profit margin, let's just keep this simple. It's sales minus cost of goods sold. So for 2018, it'd be the 3,432,000 divided by the 2.8 and change, or not divided by, minus, I apologize, will give you the gross profit. Then whatever that number is, divided by into sales is the percentage or the gross profit margin. Okay. The same with 19. You take the sales minus cost of goods sold, gives you the raw number. Take that raw number divided by sales to give you the percentage. You do the same for 20. Now on net income, because we're just going to do the two, this is easier because you have the net income and you take the net income respectfully, like that first year, 87,960 divided into 3.4 million and change. And then you put the percentage right next to the 87,960. Okay. Go ahead and proceed, everyone. Page number 8, I would do it right on the page just to keep it simple. Calculate up above first, respectfully, the gross profit. Then take that raw number divided by sales to get the percentages. Down below, you already have the number of net income divided by sales. And by the way, the profit margin down below for the industry, you can put off to the right of the 253,584 and the percentage, leave a little space for the percentage, and to the right of that for the industry. Remember we said earlier, industry comparison, oftentimes for whatever reason, you don't have the gross profit margin, but when they say profit margin at the very bottom, the 3.6, they mean net profit margin. So I put the 3.6 just off to the right so you have at least some sort of a comparison. Go ahead and proceed with the math if you would, please. Go ahead. Okay, take just another minute. Finish calculating the gross profit margin, the percentage for the 3 periods, 3 years, and the net profit margin or percentage for the 3 years. You bet. Go ahead and take just another moment or so, and then we'll summarize the numbers and then do our ranking, if you will, or rating, if you will. Okay, here we go. Jeremy, do you have the gross profit margins for the 3 periods? The percentages up above?
Yep, I got 16.55, 14.64, and 17.56.
Excellent. So rounded 16.6, 14.6, and 17.6. Excellent. Okay. Amy, do you happen to have the net profit margin for the 3 periods?
Yep. For 2018, 2.6. For 2019, negative 1.6, and 2020, 3.6.
Excellent. Perfect. Okay, here we go. Now we've got self to self and we've got self to industry, at least for the net income or the net profit margin, same net profit margin. Okay, so we've got self to self and we've got self to self on the gross profit margin and the net, and we at least have one industry comparison up above. You can even put an NA not available, but at least on the net, we got the 3.6. Just happens to match that last year. Okay, take a moment, everyone. Strong, moderate, or weak. Strong, moderate, or weak, or a little hedge in between. We can put the rating at the top of this top right-hand side of this page. Take just a moment before I'm going to ask a couple of you for your rating. Put your rating down, though. Look at the overall picture, overall comprehensive view of this 4th of the 5 models, 5-step model. Okay, Ben, here we go, Ben. Strong, moderate, or weak, a little hedge in between.
I think it's moderate for the gross profit margin, for a fairly stable trend as well. And then for net income, sort of same story we've been seeing, where 2019 wasn't good.
Okay. So overall,
moderate.
if you just had one assessment, you did the
Moderate.
2, moderate overall. Thank you. Mike, how about you? Overall assessment.
I would say moderate weak.
Moderate weak. Aline, what would you say?
I had moderate.
Moderate. Okay. My personal opinion, I would say moderate. Now, Jeremy, would you agree with me? Boy, it'd sure be nice to have a 630 of 21 interim statement loaded up to really see the trends into the new year. Would you agree?
Absolutely.
Oh, yeah. And if it's the same trend, boy, real strong sales growth and real strong net income or net profit margin. Whew, my opinion, I would be tempted to say moderate to strong, if not even strong, with a 6-month statement. With a 1 or 2 month, nah, no way. But 6 months into the new year, absolutely. Just my opinion. Questions on model 4. Excellent analysis, by the way. Excellent. Questions? Okay, let's move forward. Let's move forward to move forward to page 13. We've completed model 4. Now we're going to go to our 5th and final of the Leblanc model. Pardon me. Okay, now we have cash flow, lifeblood. Okay, cash in, cash out. We have 3 models now. Okay, help me remember, Amy. Were you were with me in the whole group was with me for the credit analysis basics? Is that what it was? Besides the tax class.
I believe so. I think
Yeah,
Ben was the
I think-
only one that wasn't
Yeah.
there for that
Oh,
one.
okay. But I think that's what it was. So we covered this, but we kind of kept it light. Today, we're actually going to crunch the EBITDA numbers. Okay, now we have 3 cash flow models in the 5th and final of the Leblanc model. The definition, if you put cash in versus cash out, and also, of course, before we forget, lifeblood. Now, the first cash flow model is the EBITDA, earnings before interest, taxes, depreciation, amortization. Okay. Now, we've got, that's the inflow. We'll do the model, just go through the model, the basic, and then we'll go back and dissect it deeper. And then we'll run the numbers on the next page. Okay. So the inflow is EBITDA, 1.2 million. Roman numeral system, commercial lenders mostly use 1M for 1,000, 2M for a million. When you read in the Wall Street Journal 1M, they really mean a million, but they're not really using true Roman numeral system. Okay. So the EBITDA inflow minus the debt service, 500,000, gives us the margin or excess of 700,000 raw number. Pretty straightforward. 1.2 million inflow divided by the outflow of 500,000 gives us the DCR or debt coverage ratio of 2.4 times. Some banks, some credit unions will call it a DSCR, debt service coverage ratio. Same thing. I saw a bank just a couple weeks ago, a particular lender, she says, we call it a DC, debt coverage. Same thing, same thing. Okay, so that's the basic flow. Now let's dissect it. The inflow, earnings, net income, net loss, before we add back interest expense. Why? This is why we add back the interest expense in this cash flow model. Because if you look up above, you can see the debt service, P&I, the interest is taken out of the model. But the truth of the matter is, interest expense has also been taken out of net income or net loss. So it's taken out of the debt service in the model, but it's also been taken out even before we take the debt service out up above the EBITDA, earnings before interest, taxes, out of the E, or the net income, net loss. So if we've double dinged them. If we don't add it back in, we've double dinged them. Let's skip over taxes for a moment. Depreciation expense, we depreciate vehicles, equipment, and buildings. Now, most depreciation is added back in. In the tax class, we talked about section 179. Now, we haven't. That one is controversial. Some lenders do, some lenders don't add it back in because it's a one-time deal, meaning they expense off the equipment they buy all in 1 year. But generally speaking, most commercial lenders, most applications, we're going to add back depreciation, non-cash expenditure. Same with the amortization. Amortization is like depreciation, but for an intangible asset, trademark, patent, goodwill, something of that nature. So we get to add it back in. That's the A. Right below amortization, I put plus depletion, D-E-P-L-E-T-I-O-N, depletion. And I'd add a D up above and a D down below. You can see the acronym to the left. I'd put a D right next to the A and up above. So it's EBITDA. Now, what's depletion? It's like depreciation, but for a natural resource, pardon me. Timber, oil, coal, natural gas. Get to add it back in. Non-cash expenditure. Now let's go back to taxes. We skipped over on purpose. You would only have the T of taxes if you're dealing with a C corporation, a traditional corporation. The T of taxes. A C corp, not an S corp, not an LLC. Those are passed through for tax purposes. So we add back the T of taxes. Why? Because with the C corp, which would only apply if it's a C corp, because taxes to a C corp are considered non-operating expenses. This is the key, non-operating expenses. So we get to add them back in. They're not part of the normal operations of the business. They're after the normal. So we add them back in. Why? Further? Well, because every year the tax code changes. Every year the C corp borrower could change their business model a little bit or a lot to avoid the payment of tax. So we don't want that to disrupt our analysis. So we add the T back. Now, we've done the math up above. We know the DCR is 1.2 million inflow divided by 500,000 outflow. How do you interpret the 2.4 times? I'd add this to your notes. Please, for every $2.40 of inflow, there's $1 outflow. $2.40 40 cents inflow, there's a dollar outflow. Well, that's strong. Look at the minimum standard, 1.20 on the bottom right-hand side. That's double. Okay, here we go, Ben. Ben, what is the typical minimum DCR that you see in your underwriting? What's your
120.
typical? Go ahead. Sorry.
120.
1.20, 1.20. Okay, Ben, have you ever seen it drop below the 1.20 in any deal ever?
Of course, yeah.
What's the lowest you've ever seen, ever, that you remember?
I mean, negative, 0.
Just a 1-to-1, 1.0?
No,
Which
no,
means-
negative or 0.
Oh, really?
Yeah.
Okay, wow. Mike, what's the lowest you've ever seen it?
I mean, like Ben on the PM side, back when I was on the PM side, I saw a few where the borrower stopped performing, were in the negative. But
Okay,
new underwriting side, if it's a deal we're going to do, the lowest would be 1.0 if it's a nonprofit.
1.0 nonprofit. For every dollar in, there's a dollar out. Good, excellent. Now, if it's below break even, 1-to-1, 1.0, technically, believe it or not, it's not a negative. It would be like a 0.9. That means for every 90 cents of inflow, there's a dollar outflow. Or a 0.50. Ooh, they're bleeding to death. For every 50 cents of inflow, there's a dollar outflow. So technically, it's not a negative. It's just, but it's definitely below break even, 1-to-1.
I've seen where they've had a net loss and then it was negative.
Oh, okay, okay, okay. I see what you're saying. Okay, you could then. Yeah. Good, good point. Good point. Excellent. Okay, now, any questions on EBITDA? Any questions? Aleem, any questions on EBITDA? The basic
Nope.
model. Okay, let's go ahead and move forward. Now we're going to calculate EBITDA for Schneider Corporation. Now, what I'd like everyone to do is use this page, page 15, but go back to page number 8 to grab, or on the income statements, page number 8, to grab, if you will, the numbers and just do the inflow for now. We'll come back together in just a moment, but just go ahead, go back to page number 8. And my recommendation is just start with the bottom, the net income or earnings, go upward. Don't try to jump steps. Go from the bottom and just add the interest expense, taxes, depreciation of it if it exists, and amortization if it exists. You can even add another D, depletion if it exists. Go ahead. Go back to page number 8, but page number 8, use the numbers. But if you'd be so kind as to plug them in on this page in this chart. Also, by the way, if you go back when you're on page number 8, under industry comparisons, you'll notice the EBITDA coverage industry is 2.0, 2.0. So if you can plug that in, DCR over to the right underneath IND in the chart 2.0. Go ahead, just do the inflow. We'll talk debt service. We'll talk about finishing the rest of it in a moment. So right now, just do the inflow or EBITDA for the 3 years, please. Take just a couple of minutes on this, if you would, please. Take just another moment. We'll summarize the inflow. Just the EBITDA, just the inflow for the 3 years, please. Okay, Jeremy, do you have the first year, the EBITDA for 2018, please?
So I got 228,000.
228,000 even is correct. Excellent. Amy, do you have the second year for us?
I do. I have $134,400.
134,400 is correct. Excellent. And Ben, do you have the third year yet?
Yeah, I got 622, 640.
Correct. 622, 640. So 228,000 even, 134,400, 622, 640. Okay, now everybody together. Don't look at your screen. I'm gonna turn back. Let's look at page number 7, the balance sheets. Now this gets a little tricky because of the sell off of 49% of the business. Traditionally, most commercial lenders, and I don't know, you may do this at NBC, maybe not, maybe you do, or some of your lenders that you work for. A lot of commercial lenders will do this. They'll determine the debt service for the most current year, and then they overlay it on the previous years. The assumption is that as a company grows, they take on more debt. It's kind of a worst case scenario. Well, wait a minute. If the debt service in 2020, if they can meet the hurdle, we said at minimums 1.20, then we overlay that debt backwards on 19 and 18 to see if could they have serviced that debt. Now, some people will say to me, especially the CPAs, when I show them this model or a similar model to this, they'll go, wait a minute. That's kind of not, you're comparing apples to oranges because you're not comparing the actual debt service of 18 to 18, 19 to 19, 20 to 20. I say, I know, but most commercial lenders will show the most current year and overlay it backward. Just a thought. Now, let's look at the debt service for 20 and we'll use it. And then fast forward back to page 15, plug it in and complete the analysis. Let's start with the long-term debt. You can see it's now 500,000. Just to keep the number simple, let's say the current portion long-term debt, which we discussed briefly earlier. The current portion long-term debt is 100,000 on this equipment loan. Let's just do on the principal. That's principal. Then there's, of course, interest on that long-term note, the 500,000. And the line of credit is now down to 300, but it's fully maxed because, they paid off some other short-term notes and it's a line of credit, but it's fully maxed at 300,000. Interest only. Most lenders on a line of credit make believe, whether or not the line is maxed, in this case it is, maxes out the line and goes interest only. Mike, in your world, is that how you do it with most of your lenders that you underwrite for? Is that how they do it? They'll make believe the line is maxed out, whether or not it is, and go interest only for the debt service.
We would either max out the line and do interest only, or depending on the situation, we might say if the line was termed out, and then use that.
Got it. That's another version. Okay, good. Excellent. So let's make believe it's interest only on the line, and there's interest on the note and the 100,000 principal. If you go prime plus 1 on that, on the notes payable on the line of credit, short-term line, year in length, prime plus 1, prime's at 3 1/4, so 4 1/4, go interest only. On the note on the 500,000, prime plus 1 plus the principal reduction. If you do that, you'll calculate like 34,000 roughly for the combined interest. Let's just keep the numbers simple to illustrate for today. And let's say, because interest rates may rise in the next couple of years, Let's just make believe instead of 34, it's up to 50,000. Interest. Aleem, do you think interest rates could climb in the next 2 years from right now in real life?
I mean, they can. Why not?
Pardon me again?
I said they can. Why not?
Oh, yeah. You said they can. Jeremy, what's your thought? Do you think rates will rise in the next 2 years? Jeremy.
I can see that. They're trying to stimulate the economy.
Okay. Amy, what about you? Do you think rates will rise just even a little bit in the next 2 years?
Definitely.
You say definitely. Okay. So we've captured this. We've gone from 34,000 to 50,000, and it keeps the math simple. $100,000 P in principal and a 50,000 interest. Okay, now hold your eyes. Don't look at your screen. Let me turn forward to page 15 on your hard copy. If you just turn to page 15, and in this, if you would be so kind, right next to P&I, if you put 100, 100, 100, and of course for the I, 50, 50, 50, so the combined debt service is 150. Go ahead now, grab your calculator, Excel spreadsheet. What is the margin for the 3 periods? What is the DCR respectfully? So you take the EBITDA inflow minus the debt service P&I, 150,000 gives us the margin. EBITDA divided by the 150 DCR, and you do that respectfully. And remember, we already have the industry DCR over to the right of DCR and right below IND of 2.0, 2.0 from page number 8 as given in the case study. Go ahead, spend just a moment on this and we'll check the numbers. Go ahead, please. Take just a moment. Finish up the math on this page, please. Okay, take just another moment. Just go ahead and finish this up. What is the margin for each period and what is the DCR? Okay, Ben, do you have the margins for the 3 years?
Yeah, I got a margin of 78,000 for 2018,
Okay, how about 19?
negative 15,600,
And the last year, 2020?
472,640.
You're correct. 78,000 even, a negative 15,600, and a positive 472,640. Excellent. Thank you, Ben. Mike, what about the DCR for the 3 years? Do you have those?
Yep, I got 1.52 in 2018,
Got it?
0.90 in 2019, and 4.15 in 2020.
Excellent. That middle year could be 0.89 or just rounded 0.90. Good. So 1.52, 0.90, and a 4.15. Pardon me. We know the industry standard is 2.0. I put another little note at the bottom of this page. Generic minimum, all industries, all over America, we know per our discussion on the previous page, the minimum DCR generic for most banks is a 1.20. So we have self to self, we have self to industry, and we even have the generic for all industries at a 1.20. Okay. How would you rate Schneider Corporation's EBITDA traditional cash flow? It's traditional because it's been around for over 60 years plus. Strong, moderate, or weak, or a little hedge in between? Take just a moment. Go ahead, take just a moment on this one, please. Strong, moderate, or weak, or a little hedge in between? Overall assessment. general comprehensive assessment, this cash flow model. Aline, what would you say? What's your assessment?
I would say it's moderate to strong, but given the 1.2. But if you look at the strength of the industry, the debt service for industry was 2.0, and it's below that. So,
Okay, moderate to strong. Okay, thank you. Jeremy, what about you? Strong, moderate, or weak, Jeremy?
Yeah, I would say moderately strong. I'd probably say strong as a one.
Okay. Amy, thank you. Thank you. Amy, how about you?
I'd go with moderate just because of
Moderate.
the fluctuation.
Okay. All right. Ben, how about you on this one? Strong,
Same thing.
moderate, or weak?
I mean,
Same?
we like to see stable trends. It's not stable at all. So I'd say
Gotcha.
moderate.
Moderate. I agree with moderate, but boy, you give me an interim statement for 3/31 of 21, preferably even 6/30 of 21, that shows the same strong cash flow trend. Whew, I'd be tempted to say moderate to strong, if not even strong. Okay, one last one. We'll move on and then take our first break of the afternoon. Before we move on, what about a loan covenant? We talked about covenants. Defined as solemn obligation between two parties, the bank and the borrower. If you were to put a loan covenant on this relationship, mathematically, what would the number be? Look at the trends. Look at self to self. Look at self to industry. Industry is a 2.0. Boy, we know the generic is a 1.20. You may say, oh, our loan covenant is just going to be the generic 1.20. Except in my opinion, you don't pick up off of anything with the current cash flow of the business and or its industry. Just a thought, at least in my opinion. Okay, take just a half a minute, everyone. What number would you use? And you would say this would be called in the business loan agreement, in the Laser Pro docs. You'd spell it out, the mathematics of how you calculate it. And you say, we want a minimum of X or whatever that number is. What is your minimum DCR? Are you going to go with the generic 1.20? You're going to go with the industry? You're going to go somewhere between? Where are you going to go? Remember, the purpose of this, pardon me, is to track the strengths, weaknesses of the borrower. It's not just for show. It's actually a tool to help the lender and even the borrower, so they know where they're at. A lot of times we forget it also helps the borrower. Okay, here we go. Jeremy, what's your loan covenant figure?
I mean, it's a little hard because it was so variable there, but I would think you'd want to track them compared to the industry in my mind, so use the 2.0.
So you're going to go with the industry of 2.0. Okay. Amy, how about you? What are you going to go with? Amy?
I would go with the 1.2 based on that's typically what we do for most standard industries.
So you're going with the generic minimum. All industries, not you're just going to go rock bottom on it. Okay. Yep. So Jeremy goes 2.0, their industry. You're going generic nationwide, every industry. Ben, what about you? What would you say?
I'd go with 1.2 because I mean we determine that to be sufficient to service the obligation, and if they do 4 times, DSC again, great for them. But if it's competitive out there too, so if you structure it up too high, in our market.
I agree. I agree with you. I agree. There's other lenders, other banks, other lenders. Oh, we're not going to do that. We don't even have a loan covenant. Mike, what about you?
We would do 1.2.
1.2. Alim, what would you say?
Yeah, 1.2.
1.2. My personal opinion, I would go 1.3 to 1.4, one of those two. I wouldn't do a range, but I do either 1.3 or 1.4. Little higher than generic, but definitely lower than their industry. But it's just to track, hey, and they have had the swings. But I would either be 1.3 or 1.4, my opinion only. Comments, questions, comments, questions.
What's your rationale, if you could put a little finer point on it, for why you would pick those
Oh,
numbers?
the reason why I would do a 1.3 or 1.4 is the generic minimum is just generic. We would want this borrower, especially because the last year of record was such a strong cash flow, to say, hey, we recognize you've had some major swings, but our generic, I tell them, or their CFO, hey, the generic is 1.2 nationwide. Well, why don't we do that? No. Your industry is 2.0. We want to make it at least more realistic, that it's going to be more the measurement is more real, not just some generic 1.0 or pardon me, 1.2 nationwide, all industries. Because we asked CFO, Mark, hey, Mark, never saw two CFOs named Mark, Bob and Susan Jane. Well, Mark, is your industry, according to our analysis, our study, the industry is truly 2.0, and he looks at you and kind of hangs his head and goes, you're right. It really is about a 2.0. It's just, boy, we've taken on the chin that middle year. Previous year to that, we were just off a little bit, but boy, that third year is really more indicative. So he says that. We say, hey, now it's 1.4. I'm just kidding. 1.5. I'm just kidding. But that's the
I
argument.
foresee a difficult conversation with them if they post 1.28 or something like that, and then you have to technically default them.
You do. But the purpose of the loan covenant is to not just for fluff or filler, but to manage the credit more closely. There is a purpose for it. And we don't want to just throw out, well, our generic's 1.20 and there you go. And they're thinking, well, that's great. Well, we've got all the freedom in the world. Plus, if their industry is truly, if Mark, the CFO, confirms it, and or Sawtooth says, oh yeah, our industry is closer to 2.0. Why would we just do the generic 1.20, the generic minimum underwriting? Remember, it's a loan covenant. It's not the same as loan approval of 1.20. It's just a thought. I wouldn't go as high as 2.0. We're definitely not above it, even though their last year blew way past that to the good. But I would put at least a 1.3 to 1.4, somewhere in that range. You know, and you get a good point. You don't want to have to go in, get an approval, hey, they blew the covenant, go all through that hassle. But at the same time, we want to track. The purpose is to help us track them, help them track themselves. Any other comments? Any other comments? Questions? You may not want to say, oh, the generic is 1.20 because Mark's going to blurt out, well, that's what we want, because he's going to know, well, that's the rock bottom. You may just want to say, you may, in your negotiation with the borrower, and which is Sawtooth and Mark, his CFO, you may say, hey, your industry is 2.0. Mark, do you agree with that? He looks at you, yeah. Sawtooth may even blurt out, oh yeah, we've tracked it for years. It's around 2.0. That's why we feel embarrassed what happened in 19, especially. We bid them wrong. We bid the jobs wrong. And then you just say, well, okay, based off of that, we're thinking of maybe a 1.4. They may think that's quote unquote gravy, or even a 1.5. In the back of your mind, your minimum is 1.2, generic. Any other thoughts? Any other questions, comments on this? Comments, questions? Excellent analysis, excellent discussion, by the way. Turn the page. By the way, one last thought on covenants, because we're not going to really come back to covenants later. I would add this to your notes as this is just a general comment on covenants at the bottom of this page. Number one thought, don't make your covenants too extreme, like we've already alluded to. Don't put it at 2.0 or 2.5 or whatever, to where they're gonna blow it, and you're gonna be addressing that issue every quarter of the year or whatever, depending on how often you're tracking this. That's the first thought. Number two, so don't make the number too high. And in my opinion, 1.3, 1.4 in this is not too extreme at all. That's the first thought. Number two, don't bury your borrower with covenants that are so extreme math that even you can't figure it out. Let me illustrate. I'm working at Valley Bank in Vegas, big regional bank. Bank of America comes to town, buys us out. They call it a merger. Give me a break. And it definitely was not a merger of equals. It was a buyout. Okay, now, within just a week or two of the merger being completed, our new chief credit officer, who was sent to Nevada from San Francisco, just walks into the loan committee and goes, from now on, you will put all of your customers under these, or you will make them subject to these 10 key ratio loan covenants. And we're like, what? Now, if you'd add this to your notes further at the bottom of this page, the three big, here are the three biggies. We've just completed the first of the biggies, meaning EBITDA debt coverage. And then there's two others. And we've already covered the key ratios: current ratio for liquidity and debt to equity for leverage. So these are the big three: EBITDA debt coverage for cash flow, current ratio for liquidity, and the debt to equity for leverage. Okay. And a lot of times you'll see them just in the order we took these: liquidity, leverage, and then cash flow, but it doesn't matter. These are the three. Okay, now back to the story. New chief credit administrator. He's new to us, not new to the bank. He'd been with the bank for 20 some odd years. He says, here's your list. Okay, we took it all back to our offices. Okay. I pulled out, I took the list. I was busy doing something. An hour later, I better look at that list. I look at the list. Pardon me. The first three calculations were the ones I just stated: the EBITDA, the current ratio for liquidity, EBITDA for cash flow, current ratio of liquidity, debt to equity for leverage. The next three were much more complicated. I'd seen them a couple of times in my career, and I could figure them out and explain them to primarily the CFOs of my borrowers. Okay, like the Marks, or if it was Bob and Sue, Jane, or whatever of the world. Okay, the last four, I looked at those, I'm thinking, what? Now keep in mind, even by that time, I'd been an accounting professor, and I'm still an accounting professor for many years. And I'm like, what? And I taught finance classes and all this. I'd seen a lot of key ratios. I'd never seen these four. So I thought, well, maybe that's just me. I went to my coworkers up and down the row, other offices. I went into Amy, lady next to me. I said, Amy, she looks at me and she goes, well, the top three are our standard. The next three I could figure out. What about these last four? I looked at her and I says, oh, that's the same experience I had. So we two went down the road to the next guy. He says the same exact thing. Nobody on the team could figure out those last four. No way. So I was the designated person to go to the new chief credit administrator of our bank and say, can you please tell me or explain these last four? Because we had the directive, you will go out to your clients and you will force them, not force them, you will have the owners sign an addendum to the loan docs that they're subject to these 10 key ratios, loan covenants. Gentleman was in his office. I showed him the form and I explained, we all can figure out the first three are standard basic. The next three we can figure out, but what about these last four? He looked at him, he looked at me, and basically said in so many words, I'm busy, get out of my office. I said, oh, okay. I grabbed my form, I walked out. I went to all my coworkers and I said, they said, what do you say? What do you say? I said, he didn't say anything. He has no clue how to do those either. We had to go out to our clients, 20 and 25-year clients of the bank, and basically off the record to their CFOs and to the owners, like the Sawtooth and Mark or Bob and Sue and Jane, and say, you know, there's a new sheriff in town, meaning the new bank, of course they knew. Can you please sign this? Most did it out of courtesy. Some said drop dead. And some of these solid borrowers for 20, 25 years, that was the straw that broke the camel's back. They were gone. Within 3 weeks to a month, they were at a different bank. They were at the competition. They were gone. I'm telling you, we lost more clients over this. So I beg of you, keep this light. Comments. Jeremy, any questions, comments on that?
Makes a lot of sense.
Good. Thank you. Let's turn to page number 16. Let's take a quick 5-minute break. We'll come on back and we'll do the last two cash flow models and then go into our spreadsheet and then our 2 advanced models, which are tied into the spreadsheet. Talk to you in 5 minutes. Thank you, everyone. Welcome back, everyone. We'll take just a moment and we'll get started. Okay, Ben, are you back with us? Can you do our sound check, please?
Check 1, 2.
All right, I love it, Ben. That is great. Okay, now personal cash flow. We did this in our the tax class in depth, so we'll keep this light today. This is, of course, for Sawtooth. We've got from his 1040, all his schedules, including K1s, 500,000 inflow, minus federal and state tax because he's based in Michigan. He pays state tax, but if he was in Texas, for example, no state tax. Texas was one of the 9 states there's no state tax, income tax. 500,000 minus 150 gives us cash flow available for debt service, 350,000. Minus the debt service personal, 200,000 annually gives us the margin. We take the 350 net inflow divided by the 200,000 to give us the DCR or DC or DSCR of 1.75. Now, 2 thoughts, we move forward. Right below debt service, you remember from our previous class, we had living allowance. So starting about 4 years ago, the federal bank examiner started to say, hey, we want to see a living allowance. And so, pardon me, we would put that in there. How, Mike, how do most of your lenders that you work with calculate the living allowance? Do they go like 15,000 per adult, 5,000 per child? How do they usually do it?
So we take either the greater of, it's a 12,000, I believe it's 12,000 for head of household, 4,000 for every dependent, or 20% of net profit or net personal income.
Net personal income, okay. And by the way, the bank examiners don't really care what you use as long as it's reasonable. And my recommendation, and Mike, is this consistent with all of the MBC underwriters, which is everybody in our group plus others? Is,
yes.
Okay, so you're consistent, because every once in a while I'll see a bank, believe it or not, a bank where you got, 2 or 3 or 4 different lending departments, maybe geographically in different towns or whatever around the state. And I'll see where every one of those teams would do it a little differently. Well, in my opinion, it should be consistent with the whole bank or the whole lending team. Now, last thought, look at the 1.20. Pardon me, you can see the 1.20, pardon me, is the minimum standard. Aleem, in your world for MBC, do you have a minimum on the personal cash flow like a 1.2 coverage?
We do not have a minimum or kind of a standard kind of a thing. We
Okay,
kind
no
of
minimum.
Okay, no on the business, yeah.
Okay, just on the business. Okay, some lenders do, some lenders don't. Some lenders just say, well, every one of these, in fact, let's turn to page number 17. They say, even on the global or the combined, they say, oh, well, we have a minimum 1.2, 1.2, 1.2. In fact, I would put right next to the 2.21 at the bottom of this page, nationwide, the minimum standard is typically 1.20 coverage. For this particular,
look at the personals in the sense that if the business is not cash flowing or if there are some kind of issues with the business having a cash flow, so then we normally go to the personal side. But
oh, gotcha. Okay, and some lenders will do that. If the business is too weak, they're going to really focus on that personal. Some lenders bypass the personal, look at the global. What I find a lot of banks and other commercial lenders today, they will look at all 3 of them. Whereas even years ago, a lot of times the middle one, which is the personal, nah, we're not as interested or we're not as concerned. We want the business, we want the global. And you'll see different banks, different lenders will have a different take on this. I will say that a lot nowadays, as I go around the country and work with various groups, are now, they're just generic. It's 1.2 business, 1.2 personal, 1.2 global or combined, and away we go. Kind of interesting. Excellent, excellent comments. Now let's move. We've completed the 3 cash flow models. Now, for whatever it's worth, on in September, when we do that first of the 3 days of advance, we will, in that advanced financial statement / cash flow analysis class, we'll go into many more cash flow models. These same 3 is foundational, but these become the foundation for several other cash basis cash flow, free cash flow, fixed charge coverage, and on and on and on, including in that class, commercial real estate cash flow models. So for whatever it's worth in September. So let's move forward though. Now we're going to go into section number 3. We've completed the in-depth on the laylock model. Section 3 will spend just a couple of minutes on the spreads because you all spread the numbers, which is great. Now look at A1 at the top. We discussed earlier 2 general rules of thumb, with all of the key ratios, self to self, self to industry. Self to self, of course, of the company's numbers relative to itself. But what about the industry, the RMA, Risk Management Association, S&P, D&B, S&P, Standard & Poor, D&B, Dun & Bradstreet, and then, of course, SageWorks. I'm drop down to number 2, spreading the numbers, but SageWorks does have that industry comparison built in. These others don't, not to the level, my understanding, not the level of SageWorks. You can see even Excel. Some institutions, hey, some small banks, we don't have the budget for that expensive software to spread those numbers. We just create an Excel spreadsheet. Buchers, I put a little note, is based out of Oregon. They started out as a spreadsheet, lack of a better word, analysis company, kind of like Moody's, kind of like SageWorks, Baker Hill, but on the tax side. But I've noticed in the last few years, they've expanded to where the source document can be company prepared, CPA compiled, CPA reviewed, CPA audited, whatever, non-tax. But their original was tax. Kind of interesting. Now we're going to look at the spreadsheet here in this section number 3. When we get to the back of the spreadsheet, we'll go into our 4th and final section of today's webinar, and that is the bankruptcy, Altman Z-score, and sustainable growth models. So hold that thought on 3 and 4. We'll see in just a moment. Let's turn forward to the spreadsheet. This is our second major case study of the day. Sample Contractor. It's a real company. They do fire, flood, mold remediation. That means when there's a fire in a home or in a business, they go in, they clean it up, they take samples, send it to a lab to make sure there's no mold before they seal up the walls. Okay. Now, these are in thousands, of course. This is Moody's, similar to what you're used to on SageWorks, all of you in the spreads. Look at the years, 08, 9, 10. This is the Great Recession. These were pretty gory years. These were tough years. And the numbers are going to see it. We're going to see it on here. Now, there is an interim for 2011. Pardon me, the challenge is only 1 month. It's only 1 month, which is why I use this case study. We haven't seen numbers like this, even during the pandemic. Unless you're in an industry such as a restaurant or a bar or entertainment, a lot of businesses didn't even hit this level. The Great Recession back in 08, 9, and even 10 in some markets around the country, in my opinion, was a broader downturn in the market, definitely more than COVID, in my opinion, meaning it was a more general recession. Let's move forward. We insert, of course, and you all do this, so we're just spending just a couple of minutes on this. We're going to get to the key ratios and work on comprehensive activity in just a minute. Here we have the balance sheets inserted or spread. Page number 2, the income statements, insert or spread. And I recognize, having spread many statements over the years myself, it is tough at times. Amy, have you ever had a challenging spread to do ever? Just in the last 2 months from now?
Yeah, of course.
Of course. Why? Why don't you? I'll have people that have never spread the numbers. Well, how hard is it? You just take revenue from the income statement, plug it in. But
I
Amy,
mean, sometimes
ahead.
they don't make sense. You know, sometimes there's just so many lines of expenses versus if you get a tax return, everything's, you know, combined in a more
Yes.
centralized category. And
yeah,
if there are a lot of, you know, expenses, making sure that they line up to where they were put in previous years.
yes, good point. In fact, some people, because I've spread both, we've all spread both financial statements, tax returns, 2 different source documents. Some people say, well, I'd rather spread the financials. Other people say, no, I'd rather spread the tax returns. But the negative tax return, Amy, you just hit it on the head, is that some of those categories are combined, so you don't have as much detail. So you're kind of limited in some ways. So I mean, there's pluses and minuses. Good, excellent comment. Let's turn to page number 3. Here we see the common sizing of the income statement. This is model number 4. This is model number 4. We see the gross profit, net profit, left side. Go over to the right respectfully, and you'll see, of course, the raw number and then the percentage, like we did in model 4, operating performance. Page number 4, we'll bypass. This is the UCA cash flow, uniform credit analysis cash flow. We'll save this for September 15th when we do our part of that class is advanced cash flow, absolutely. But we will save that for that date. Now let's turn to the last page of the spreadsheet, the key ratios. If you'd be so kind, top left-hand side of this page, liquidity, if you put a number 1, if you go down about 2/3 of the way down next to activity, if you put a number 2, this is just the laylock. This is the laylock model. So liquidity, top left-hand side, activity, 2/3 of the way down, back up towards the top, leverage, model 3 leverage, the middle of the page, profitability or operating performance, model number 4, and then just above profitability, the words cash flow coverage, model number 5. Okay, now to simplify, pardon me, the laylock model, if you turn to page number 24, this is a spreadsheet that I prepare. You notice I've broken it into the 5 steps. Pardon me. You notice I've even put a little definition, and you'll notice I've also added on this spreadsheet the RMA or Risk Management Association industry studies. Like, for example, look at the current ratio. First off, the 4.91, I'd slash through that. That's an odd number. But look at the other numbers, consistent, but they're low, they're weak. But look at the industry. In RMA statistic, they use the numbers from the input, and then they do their statistical studies. The upper quartile, for whatever it's worth, is the 2.5, mid to 1.2, lower quartile, whatever, in their analysis, 0.7. So you can see they're above the 0.7, they're kicking, they're still alive, and nothing to write home about, in my opinion. Okay, look at the next one, activity, ARAP. Look at the 3 days I'd slashed through. That's kind of odd. Self to self, look at self to industry. Look at the industry. Look at leverage. Even though it's the company has a negative net worth, and that's why they're all negative, debt to worth or debt to equity, same thing. Look at the industry, negative 14. Then we have operating performance, and then we have cash flow. This is our comprehensive case study for the laylock model and using, remember, we're interpreting. You didn't spread these numbers. These were already done. Now we're interpreting. Like to have you take a couple of minutes, everyone. Go model 1, model 2, 3, 4, and 5. Comprehensive, like we've been doing throughout the session today. Self to self, self to industry. Not all of these have industry comparisons. Most do, but not all. And then over to the right, for example, liquidity, just one comment to the right. Comprehensive, strong, moderate, or weak, or a little hedge in between. The same way with activity. Look at the overall self to self, self to industry, and a comment to the right, all the way down all 5 of these. Take a couple of minutes, everyone. Work on the Leblanc model for sample contractor. Please. Go ahead. Proceed. How would you rate? And you can do a little hedge if you believe it's appropriate. Otherwise, a strong, moderate, or weak, or a little hedge in between. Go ahead, please.
I'm sorry, real quick, what were the 3 numbers under the RMA?
Those are the ranges. Those are called the upper quartile, mid quartile, lower quartile. Those are the, instead of just giving one number. Now, some of these are one number. Like if you look under operating performance, you see net profit margin. Well, it's one number. It's a fixed number. But several of these, the 3 up above, you'll notice is a range. So for example, we know liquidity, the more the merrier. So the upper typical upper is 2.5, mid to 1.2. Oh, they're at the bottom, but they're still above the 0.7. Look at AR. Boy, some 0, the midpoint 14 is as low or as stretched out as 35, which was similar to what they started at. They were even beyond the industry back in 08, 09. Do you see that? Does that help?
Yep, yeah, that does. Thank you.
You bet. You bet. Go ahead and proceed, everyone, please. Okay, take just another moment and we'll summarize these. Take just another moment or so. Strong, moderate, or weak, and for each, just the comprehensive for each of the 5, or a little hedge in between. Okay, let's start with liquidity. Ben, what would you say? Strong, moderate, or weak, or a little hedge in between?
It's weak. It stinks.
You say, I love it. You say weak. Okay. Mike, what do you say about liquidity? What's your comment?
I would also say it's weak.
Got it. Got it. Okay, now Model number 2 activity. Elaine, activity model 2. Elaine, what do you say? Strong, moderate, or weak? Or a little hedge?
I had moderate.
Moderate. Okay. Jeremy, activity model 2. What would you say?
I said mid-strong. The AR in particular was very strong, even though it declined at the end. So
Okay, you say strong. Okay. Amy, what do you say about activity? Strong, moderate, or weak, little head or a little hedge?
I would say moderate, but it definitely has improved in 2010
Okay.
compared to the previous 2 years. And the
Okay.
year-to-date statement doesn't look bad either.
Okay, good. Model number 3, comprehensive, your assessment leverage. Ben, what would you say?
But moderate to weak. For
Moderate
leverage.
to weak, moderate to weak. Mike, how about you?
I would also say moderate to weak.
Okay. Model number 4, operating performance. Model 4, operating performance. Aleem, what would you say? Strong, moderate, or weak?
That would be, it's strong.
Strong. Okay. Jeremy, what would you say for model 4, operating performance? The profitability or lack thereof?
I think I would say strong too.
Strong also. Okay. Lifeblood. Cash flow. Model 5. Amy, what say ye? What's your assessment on cash flow?
Hold on a second. Sorry, it like
No problem.
went off my screen for a second.
No
For
problem.
cash flow,
Yep. Model 5.
I would say moderate,
Moderate.
just because of the variability between the different
Okay.
periods.
Okay. Thank you. Ben, how about you? Cash flow, strong, moderate, or weak?
I had the cash flow as weak.
Weak. Okay. Mike, cash flow, strong, moderate, or weak?
I think I had it as like weak to moderate because
Okay.
it's better recently, and there's a reason it was not great in 08, 09. But
Okay.
I said moderate weak.
Okay. All right. My assessment on liquidity, weak. Activity, moderate. Leverage, moderate. Operating performance, moderate to strong. Boy, give us the 6-month statement instead of that 1 month with these numbers, and I'd be tempted to say strong. Cash flow, weak to moderate, moderate to weak, as was just mentioned. Absolutely. Okay, we're going to ask one more question. We move on. Based upon these numbers, which are real numbers with a real company, would you lend them on, if they came to your bank right now and said, we want to apply for a new equipment loan? Now, this is a small contractor. They do the fire, flood, and remediation. They have certain equipment that they use to rip out, when the wall's half burnt and rip it all out. And they do have subcontractors, like the penny and drywall contractor to repair it and all that. Would you lend them, based upon this analysis, $100,000? Just when you look at this comprehensive laylock model, yes or no, would you do $100,000? Take just a moment. I'm going to ask a couple of you. Just yes or no. Would you give them an extra 100? Aleem, would you do it? Yes or no?
I would say, looking at the situation kind of changing in the recent periods, I would give them.
Okay. Jeremy, yes or no? Would you do the deal? Would you give him 100, Jeremy?
I think I would want to structure the covenants though and keep an eye on.
Okay,
Oh,
but you're a yes. Aleem, were you a yes or a no? I couldn't hear you. We for some reason that
Yes, I
muffled.
was a yes.
You say yes. So Jeremy, yes.
Yeah.
Aleem, yes. Amy, yes or no on this deal?
Yes.
Yes. Most banks today would do it. Absolutely. Nothing to write home about. But for small operating business, boy, these are classic numbers. Plus, they did come out of the recession. They did survive. It'd almost be like a company that got hit during COVID. And, and then we see, a year or two or three from now, when we see all the numbers. Same idea. Let's move forward to page 25 now. Let's go ahead. We'll stop right there. Let's take our last quick 5-minute break. We'll come on back. We'll do our fourth and final section, 2 advanced key ratios, and get you on your way for the evening. Talk to you in 5 minutes, everyone. Excellent analysis, by the way. Very good. Welcome back to our last little section. Let's see. Aleem, are you back with us? Aleem, can you do our, there we go. There we go. Sound check. Thank you so much. Welcome back. Now we've got just our two last key ratios. These are comprehensive models, the Altman Z-score and sustainable growth models. Now, before we get into these two models, I just want to show you where on the spreadsheet these probably show up in SageWorks. If you turn back page 24, page number, the previous page 23, at the bottom of this last page of the Moody's spreadsheet in the key ratio page, under activity, do you see about 3/4 of the way down, the Z-score? So you're back on page 23, just turn back a couple of pages. If you would please highlight Z-score and the numbers to the right. And then at the very, very bottom, if you'll highlight sustainable growth and the numbers to the right. Okay. So I just want to show you where I got them from. Before we proceed forward, Jeremy in SageWorks, because there's different versions. You can buy SageWorks, you can buy Moody's. Sometimes it does, and sometimes it does not include these two comprehensive and advanced key ratios. In your version, pardon me, SageWorks, do you see the Z-score, Jeremy?
Yes, I've seen the Z-score, especially in our
Okay.
rating.
Okay, you do. And what about, Jeremy, what about on sustainable growth? Do you know if you've got that one in your version of SageWorks?
I don't recall if I've seen that one or not. I mean, I
Okay, so
feel
you
like
did.
it probably does, but it looks pretty similar to what we're seeing on this page. But
Okay, got it. Because sometimes I'll hear commercial lenders that take this class and they'll say, well, we have SageWorks or we have Moody's, we don't have that. Well, sometimes some of the software companies, they quote unquote force you to pay more money to get these advanced models, if you will. So for whatever it's worth. Turn forward, page 25, Altman Z-score. The correct title is Altman Z-score. This was created originally in the late 1960s, but it's been tweaked by Professor Altman. It's been tweaked, it's been updated ever since. You can see the variables down below. Okay. Now, what is this? This is a comprehensive key ratio. Whereas if you look at the variables under A through E at the bottom left on this page, much, if most, not all, but most of the Leblanc model is embedded within this model. Working capital, for example, indication of liquidity. Under Part C, you can see earnings before interest and taxes divided by total assets. Well, we've got the EBITDA, there's the cash flow and so forth. Do you see the market value? Because most of your borrowers are not publicly traded, they're privately held, small to medium-sized businesses. I'd slash through market value and put book value of the equity. Okay. Now, let's turn forward to page 26. This is how we read the Altman Z-score. These numbers, I had you mark just a few pages back on the last page of the Moody's spreadsheet, the key ratio. So that's where the 2.9 to the negative 0.93 and so forth came from. I've just restated the numbers. Now look at the scale down below. This is what I've added to this page. You have an Altman Z-score over 3. In theory, they're far from bankruptcy. Gray zone, 1.81 to 3, kind of in the middle. 0 to 1.8, this is my slang terminology, death zone. Death zone. Okay, now, look what happened to Sample Contractor. Real company, real numbers. I went to the owner in 09. Of course, this was the peak of the Great Recession, especially in Las Vegas. We were late getting into the recession, late going out, but I said, in 09, I said, you're going to go BK, because I could just see the numbers deteriorating. He didn't believe me. He goes, oh, I don't believe all that gobbledygook. I said, look at it. He goes, then he starts going, now, what are these numbers? What are these numbers? And I explained to him the model. He took it to heart. He said, you know, I know what I'm going to do. What did he do the next morning? Called, it was a small company, this sample contractor, they do the fire, flood, mold remediation, clean up the mess with the fire or whatever. He called his 4 senior managers in the room. Just the company only had like 18 employees or whatever. He said, you have 30 days to turn the ship or I lock the doors, everybody goes home. Because this gentleman actually was a major player, owner in a different company. This was a small side little business. Well, they took it to heart. Look what they did. They first off, they laid off about 3 non-productive employees. What do you mean by non-productive? Well, one of the gentlemen, they couldn't get him out of bed to come to work, except on Friday. Why? Because the paycheck was there. They called him and said, hey, we got good news. You don't have to come in to get the check on Friday. Oh, great. Can you mail it to me? Yeah. Well, by the way, that's your last check. What? Number 2, even more impact on the numbers. They started bidding the jobs tighter. Number 3, they started delivering in the field tighter. They used to have the big dumpster. They have so much wasted material. Oh, no. They got it down much more efficient. True. This is all true. Real company, these are real numbers, real company. Look what happened. They came out of the recession. Plus, look at these numbers. Real numbers. Look at the scale down below. Now, just 2 more thoughts when we move on. First thought, sometimes you will see a little different scale. Instead of over 3, it's like over 2.6, and maybe the middle is 2.6 or whatever, 2.59 or whatever, 1.65 to 2.9. Maybe let's start over at the first. Maybe 0 to 1.65, the middle gray zone, 1.66 to 2.9, and anything over 2.9. So this can also vary by industry. For example, the farm industry. And Amy, do you, I don't recall the group, MBC, do you do any underwriting for ag credits? I don't recall.
I don't believe we have any on our books. In the past, we've had a couple come through new underwriting, but they never closed. Gotcha.
So it's not where versus other parts of the state of Michigan, ag obviously is huge. Well, much bigger anyway. So even ag has its own scale. It's a little different. And let me give you another illustration. A couple years ago, I'm in Detroit, okay? I'm in Troy to the north, okay, the suburb. I'm training the CPAs because I train the CPAs physically in Michigan and the bankers. Okay, now, at the end of the session, I had and these were mainly CFOs. They're CPAs, so they're getting their hours for their license, but they're CFOs of the various companies. Had a gentleman come up to me, CFO, at the end of the session. He goes, you want to see my Z-scores? I go, yeah. Opens his laptop. And he is the CFO of a manufacturing firm in the Detroit market. Okay. Opens his laptop. He has 10 years, all color-coded Z-score, Altman Z-score for his company where he's the CFO. Fascinating. His scale was a little different. Similar. The relationships were the same, little different numbers for his industry. Just thought I'd point that out. Now let's go back 1 page to page 25. Some bankers, some lenders, as I mentioned earlier, they don't have the Z-score embedded within their software, or Moody's or SageWorks, whatever. Or if they're using Excel, they're not going to have it. I would put at the bottom of page 25, you can create your own Altman Z-score. You Google Altman Z-score. If you Google Z-score, you'll get your old Z-score that you may remember from your statistics class back in college. So you've got to Google Altman Z-score. There are several options, free of charge, Excel-based templates. Now you have to plug in the variables, A through E up above, you can see, but you can run them. You can run the Altman Z-score. And of course, going forward, use the scale or the appropriate scale for the industry that you're working on. I've had several credit analysts that have taken this class and a few of my other classes, and they've actually done it. They use Excel. They're in a small, little, tiny community bank. They don't have the budget to buy the Moody's or SageWorks or Baker Hill or Buchers or whatever, and they create their own. Moving forward, our second and last model of the day. Sustainable growth. This is relative to sales. If you will highlight the middle of this page where it says in order to grow faster, please. That little paragraph, if you'll highlight or circle it. This model, quote unquote, assumes that, as you can see on that paragraph, no additional equity capital. That means new, of course, equity from outside. No increase in financial leverage, debt from outside, or improvement to the profit margin of the business. It's kind of a status quo type model. Small businesses, Bob and Sue or Sawtooth, they would have to insert equity from outside or get a loan from your bank or improve their profit margins. But this model tells us how much can they grow without any additional outside support. And by the way, even a large business like Walmart, their equity, they'll issue a new $100 million in new common stock. That's equity. They'll issue a new $100 million bond or financial leverage debt. And they're constantly working on their margins, of course, because even a fraction of margin with the volume of the billions of inventory they flow through their system will improve. Kind of interesting. Let's turn to page number 28. These are the numbers I had you highlight at the very last page of the Moody's spreadsheet for sample contractor. In theory, they could grow from 08 to 09 about 107%. The next year, 63% rounded, but they eventually slow down. Even in Walmart, if they did not have outside support from the new common stock or equity and the new bond issuance of the bonds or debt, they'd have the similar. You cannot, unless you're including that, you just can't support your growth. Even a Walmart can't. This is kind of an interesting model to view. Now, my personal opinion of these two advanced key ratios, the Altman Z-score, is the most applicable to you as a commercial lender. Just going back, hold your eyes, go back just 2 pages. What better than to have a comprehensive model that tells you which way is your borrower going? Are they marching towards or away from BK, bankruptcy? Just a thought. Okay, now let's move forward. Turn forward to page 29. In conclusion, most all of us have heard the saying, cash is king. Well, we saw in the Great Recession, oh no, it dried up. And even to a degree during the era of COVID, not as general in my opinion. Pockets, more pocketed. Industry in certain areas of the country. Credit's not king. I would please circle or highlight 1C. Cash flow is king. Thinking back to the 5-step laylock model, the most important, whether it's short-term or long-term, is cash flow. Look at number 2, figures lie, liars, figures. I got that from my old boss years ago. She used to tell me the numbers. She used to say, David, if the numbers just don't look right, if they're just too good to be true, they probably are, including the key ratio numbers. Negotiate. You can negotiate. You can be a decision maker. You do the numbers, you interpret the numbers, not just calculate. We manually calculated to, quite frankly, to help us better interpret the numbers. And then, of course, you use your spreadsheet, your SageWorks. But you can do it, and you can be a better decision maker. Okay, now in conclusion, we're going to do a quick activity. I'd like everyone spend just a minute and go back in the PowerPoint presentation. What are just 1 or 2 ideas that you can take from today's session that will benefit, that will benefit you? So, and there's no right or wrong. We're not looking for a magic answer, no right or wrong to this. But what is just one or two thoughts, takeaways from today's session? So go back all the way to the very first page, and I just thumb through, and then write down the one or two thoughts at the bottom of this page, page 29, underneath number 4, right in that little section, if you wouldn't mind, please. Just one or two thoughts. No, don't. I mean, it could be a major model. It can be just one little thought or concept we covered. Absolutely. Go ahead, take just a moment. Just one or two ideas. Okay, here we go. Jeremy, what are just one or two thoughts that you have, takeaways that you can take and that will be valuable to you to help you as an underwriter, so forth? What are just one or two thoughts?
Yeah, some of the ones I really liked were when you were introducing the Leblanc model and kind of discussed which of those ratios are the most relevant for short-term versus long-term, and sort of having it in that framework to know which ones you're looking at first and foremost there.
Okay.
And then also when we were discussing like the guarantor's personal liquidity, just the actually knowing what those percentages are that are typically used in the industry to determine how much of that you would truly consider as liquid assets. That's
good. Good. Excellent. Thank you. Good. Thank you. Amy, how about you? One or two thoughts from today?
I really like that it was just all NBC people in the training. I felt like we were able to customize it a little bit better to what we do here. I mean, it's always fun when we have, other groups of people to see what they're doing, but I felt like we got to touch a little bit more on, what we do here at NBC versus, agriculture, which, we don't necessarily do.
Yes. Yeah. Good. Good. Thank you. Ben, how about you? What's your one or two items?
I like the Leblanc concept, like what Jeremy said. It's logical and it flows from the most immediate to the most long-term debt. That I haven't seen it presented that way. I like that. I like the asset test as a look at the balance sheet, because we don't have inventories for most of our borrowers. So I just kind of made a little asterisk that I like that. And then I've heard cash conversion cycle mostly just talked about in sort of qualitative terms, like, oh, it's fast or it's slow, but I didn't really dug in to quantify it. And it is a quantitative measure. Yeah. So I like that we got the to work with that one kind of actually with the numbers. So
okay, good, excellent. Mike, how about you? Thoughts? One or two items. Go ahead.
Yeah, I would like to echo. I enjoyed learning about the Leblanc model, but then I also really enjoyed, learning how to calculate the different activity ratios between the AR, AP, and inventory turnover ratios, because there's something that we always see on SageWorks, and I've always included in the analysis. But if you had asked me to calculate how we got those numbers, honestly wasn't confident in how to calculate those numbers before this. And then looking how those, like Ben said, with the cash conversion model and how those relate, I thought was really informative.
Okay, great. Thank you. These are good. These are really good. Liam, how about you? Just one or two thoughts.
Yep, I had the same with activity ratios. Usually we see them on SageWorks and we slightly touch on them too when we're doing our analysis, but
so activity, good.
How we get those numbers was something that I really found helpful, and overall, all the ratios that we went over, it was overall a very good kind of a revision of things that we did in our school that had been kind of gone for a while.
Okay, great. Well, thank you, Aleem, and thank you, everyone. That was excellent feedback. Now, we do have this taped, and Stephanie, our administrator from the Michigan Bankers Association, she's going to send that out, I know, and I think there was a couple of people that couldn't join or what have you, but so we do have that. I want to thank you all. This was excellent participation, excellent all the way. Questions and the comments, feedback, and so forth. Even this summary was really well done. Once again, and I recognize now that you kind of reminded me, hey, the group, we've already done the basic tax. So I thought we're all going to be tomorrow, but we have another group evidently. But I do recommend that you consider the advanced classes. September 15th, advanced financial statement and cash flow analysis. September 16th, advanced tax. And September 17th, the CNI lending in the morning, CRE lending in the afternoon. So just a thought coming forward for this group, and then others. I know you've got other individuals in your team, but just if there's any questions as we started out, I mentioned, and you've got my email address, please send me an email, whether it's a question related to the subject matter today or in the past, or even these classes coming up. With that, thank you all for attending. Have a good rest of your afternoon and evening. Thank you so much. Thank you, everyone.
Thank you, David. Thanks for your time.
Thank you. Thank you, everyone.
Thank you.
Thank you. Good night, everyone. Thank you.
Right.